Hello, all my dearest students of Full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So today we are going to continue with our series of revision, comprehensive revision, that too in Full English along with Hindi revision videos. And today we are going to start with the international taxation first topic, that is non-resident taxation. This is one of the most important topic for your examination. 100% questions will come out of this topic for 8 to 10 marks minimum. Transfer pricing and non-resident taxation, these are the two topics which always come in the CA final direct tax papers. Okay. So without wasting any further time, let us start with the revision of non-resident taxation today. The very first thing that we need to see in this particular chapter is section 5. What does section 5 says? Section 5 talks about scope of total income. Whose income is taxable in India? Now that depends upon two factors. First is residential status. Second is accrual and receipt. If you are resident in India, then it is taxable, or if your income is accrued in India or received in India, then also it is taxable. So therefore, you need to first of all find out the residential status, and then we need to find out the accrual and the receipt concept. So we are taking a synopsis of all of them first, and then we will talk about in detail about residential first, and then we will also talk about what the deemed accrual and the concept of receipt in a later discussion. So first of all, if you are a resident and ordinary resident, then it doesn't matter where the income is accrued, where the income is received. It is accrued in India, it is accrued outside India, it is received in India, it is received outside India. Everybody is going to pay tax in that case. Okay, it is very clear. But if you are a not ordinary resident or if you are a non-resident, then you will be taxable only if the income is received in India or deemed to receive in India, or accrued in India, or deemed to accrue in India. There has to be some relation with India. Then only a not ordinary and non-resident will pay tax. If the income is accrued or deemed to accrue and received and deemed to receive, everything is outside India. It is accrued also outside India. It is received also outside India. Then NOR and NR, both of them are not going to pay tax. Now you will say, by that logic, NOR and NR are one and the same. No. They differentiate in the last point. If the business is done outside India, or if the profession is set up, if the profession is done outside India, listen carefully. This is the third place where both of them are going to differentiate. See, for RNOR, every time RNOR is going to pay tax. For RNOR, you are not going to see anything. Whether the income is accrued in India or accrued outside India, received in India or received outside India, if you are an ordinary resident, world income is taxable. But for NOR and NR, income has to be accrued in India or received in India or deemed to accrue in India or deemed to receive in India. Either of the four things should happen in India. If everything is happening outside India, then they are not liable to tax. But NOR and NR differs at one place. If the business is done outside India, if the business is accrued outside India, but it is controlled from India, then NOR will pay tax, NR will still not pay tax. NR will only pay tax if the business is actually accrued in India or deemed to accrue in India. Just because it is controlled from India, NR will not pay tax. So here the difference starts between NOR and NR. Or if the profession is set up in India, but it is accrued outside India. Where is the profession set up? Profession is set up in India, but accrued outside India. NOR will pay tax, NR will not pay tax. Now we will try to understand the meaning of these four terms. Sir, what do I mean by the term accrued in India? Accrue means what? Accrue means the income should be generated from India, or the source of income should be India. Sir, what do I mean by received in India? Received in India means when it is received for the first time. Wherever in the entire world it is received for the first time, that country will be called as country of receipt. Suppose you have a property in London and you have received a rent in the bank account in London, and then you are remitting that bank account money from London to India, then it is not said that it is received in India. It will be said that it is received in London only. Subsequently, where you remit, it doesn't matter. Okay. Subsequently, where you remit doesn't matter. Where it is received for the first time, that matters under the income tax law. Thirdly, so what do I mean by the term deemed to receive in India? The term deemed to receive in India is defined under section 7. Now what is written in section 7? Listen carefully. All these points are related to the chapter of salary, and therefore it is not much important for us, because in CA final the chapter of salary is not relevant now. If the employer contributes more than 12% of the salary to what? Recognized provident fund, or interest in excess of 9.5%, then that is deemed to be received in the hands of assessee and it is liable to tax. Similarly, if an employer contributes under a pension scheme, NPS, notified pension scheme, then that is also deemed to receive in the hands of the employee. Third, if the amount is transferred from unrecognized provident fund to recognized provident fund, then the employer contribution and the interest on the entire employer contribution is also deemed to received in India. So what I have explained you, I have explained you what do I mean by received in India, deemed to receive in India, accrued in India. But deemed to accrue in India, I have not explained you so far. That we'll be discussing later on. That is a very long discussion which is given under section 9. So now we are going to start with our residential status first, and then we will talk about what other aspects of this chapter. Okay. From here you can see your real chapter starts. Residential status has to be divided into different persons. We need to know the residential status of individual. We need to know the residential status of company. We need to know the residential status of HUF, LLP, AOP, BOI, everybody. First, we will talk about individual because that is the biggest and one of the most important. Individual residential status and company's residential status is important for your exam. Rest of them are not that important for your exams. So, what is individual's residential status? There are multiple categories in that. Category 1, Category 2, Category 3, Category 4. There are 4 categories for individual's residential status. Category 1. Residential status of individual. When an individual will become resident in India. If he stays in the previous year, that is the previous year 24-25, this is our current previous year. If he stays in the previous year 24-25 in India for 182 days or more, then he is resident. Second, if you do not fulfill this condition, then you need to fulfill the second case. You should stay in India for 60 days at least in the current year. In the previous year 24-25, you should stay in India for at least how many days? 60 days. And in the last 4 years, you should stay in India for 365 days. Even if you fulfill this condition, then also you are resident. So either you fulfill the condition of 182 days or you fulfill 60 plus 365 in the last 4 years. When I say last 4 years, don't count the current year 24-25, start from 23-24. Okay, I hope it is clear to all of you. Now, once you become resident, there is also a possibility that you can be an ordinary resident, because once you become ordinary resident, there can be world income which is taxable in your hand. To become an ordinary resident, you have to fulfill both the condition. If you fulfill both the condition, you are ordinary. If you violate any one condition, then you are not ordinary. So what are the two conditions? First, out of the last 10 years, exclude the current year, exclude 24-25. Out of the last 10 years, you should be resident in India in at least 2 years. And in the last 7 years, exclude current year. In the last 7 years, last consecutive 7 years, you need to stay in India for 730 days or more. The moment you fulfill this condition, you will be called as resident and ordinary resident. I hope it is clear to all of you. This is our first category. In first category, everybody will come, everybody. But second, third and fourth category is for certain specified person. It is not for everybody. Like second category is only for Indian citizen, Which kind of Indian citizen? Who leaves India during the previous year 24-25. For what purpose? As a crew member of an Indian ship or for the purpose of employment outside India. So if 4 conditions are fulfilled, you will come under category 2. If you are an Indian citizen, you are leaving India during the previous year 24-25 as a crew member of Indian ship or for the purpose of employment, not for the purpose of roaming, not for the purpose of foreign tour, not for the purpose of business visit, for the purpose of employment outside India, then the condition of 60 plus 365 is not applicable. This second case is not applicable. In that case, only 182 days criteria will be applicable for you for the purpose of determining the residential status. You will become resident only if you stay in India for how many days? 182 days or more. Then the condition of 60 plus 365 is not applicable for this second category person. Now for the second category person, there is also one rule which is notified by government, that how will they identify in case of foreign going ship, how will they identify that how many days you are in India and how many days you are not in India. So for example, I am a crew member of an Indian ship. The moment I enter the ship, the captain will sign in a continuous discharge certificate. Continuous discharge certificate is nothing but a license given to me. The captain will sign in that on this date we are leaving India, and when I come back, the captain will sign off on this date we have come back to India. So the period beginning from the date on which it is signed in till the date on which it is signed off, that much period will be excluded for the purpose of determining what? The residential status in India. I hope it is clear to all of you. So the period entered on the date on which the continuous discharge certificate is signed in till the date on which the continuous discharge certificate is signed off, that much period will be excluded as if you are not part of India. Okay. Now the third category, one of the most important category. The third category is applicable for whom? It is applicable for Indian citizen or person of Indian origin. First of all, we need to understand the meaning of person of Indian origin. Indian citizen means all those who are born in India are Indian citizen, or all those who have taken citizenship from the government of India separately. They are also called as Indian citizen. There are two reasons, there are two ways in you can be citizen of India. Either you are born in India, you are citizen of India, or somebody has given, the government of India has given you an honorary citizen from their side. Then also you can become citizen of India. Now, but the person of Indian origin is what? When I can call myself as a person of Indian origin, when I, listen carefully, when I or my parents or my grandparents, maternal grandparents or paternal grandparents, both, either of them were born in undivided India. If any of us were born in undivided India, then I will be called as person of Indian origin. Okay. So now listen carefully. If you are an Indian citizen or if you are a person of Indian origin. In the previous category, person of Indian origin was not covered. In category 3, person of Indian origin is coming. It's visiting India during the previous year. Visiting means what? Are you coming permanently? No, no, no. Temporarily visit. That can be business visit, personal visit, tourism visit, any visit, but it has to be visit. You are not permanently shifting India. If you are permanently shifting into India, then go to category number 1. Then you cannot come over here. So if you are an Indian citizen or person of Indian origin, you visit India during the previous year for less than 180 days, close your eyes and say non-resident. If you come to India for 182 days or more, close your eyes and say resident. Then in that case, if you have to fulfill the 2 additional conditions, then you are ordinary resident. If you don't fulfill the additional condition, then you are not ordinary resident. So in the first column, it is always non-resident. In the third column, either it is ordinary resident or not ordinary resident. Ordinary resident, if you fulfill the additional conditions, 2 conditions, then ordinary, otherwise you are not ordinary. Now what about those people who come to India for what? 120 days to 181 days. Then you will not come in the first column, then you will not come in the third column. Then you will come in the second column, and in the second column, if you fulfill 2 conditions, then you will be called as not ordinary resident. And if you don't fulfill both the condition, even if you violate one of the condition, then you will be non-resident. So if you fulfill both the condition, then you will be not ordinary resident. This middle person can never be ordinary resident. This middle person will always be not ordinary or non-resident. So when he will become a not ordinary resident, he has to fulfill 2 conditions. Which 2 conditions, sir? In the last 4 years, he should stay in India for 365 days or more. And the total income other than foreign income, that means from Indian total income should be more than 15 lakh rupees. If his Indian total income is more than 15 lakh rupees and out of the last 4 years he is staying in India for 365 days or more, then in that case he will be called as ordinary resident, not ordinary resident, sorry. And if he violates any of the condition, then he will be called as non-resident. So when we compute the total income from India, then what all we include? We will include everything that is earned in India, that is received in India, that is accrued in India. One more thing you will take in over here. If a business is done outside India, but it is controlled from India, that will be considered as an Indian income and not foreign income. That is mentioned over here. Foreign income will not include those incomes which are accrued outside India, but the business is controlled in India. Profession is accrued outside India, but set up in India, that will be considered as Indian income. You have to consider that in the column of 15 lakhs. I hope it is clear to all of you. And the fourth and the last category of residential status of individual is if you are a deemed resident. Again, this fourth category is for a very specific person, that is Indian citizen. If you are an Indian citizen and if your Indian income other than foreign income is greater than 15 lakh rupees and you are not liable to tax in any other country in this entire world. Listen carefully. You should be Indian citizen. Your Indian income, total income should be more than 15 lakhs and you should not be liable to tax in any other country in this entire world. Then the government will tell you not ordinary resident. What they will tell you? Not ordinary resident. And if you violate any of the 3 conditions, then you will become what? Non-resident. Sir, what do I mean by liable to tax? Liable to tax means there is a tax which is imposed on you, and even if the tax is exempted by foreign authorities, that will also be liable to tax. Suppose Singapore government is imposing tax on you, then you are liable to tax in Singapore. Singapore government is imposing tax, but for the time being they have exempted under some provisions of their law, then also it is said to be liable. Liable means taxable also and exempt also. Both are covered in the definition of liable. So these are the 4 categories which are relevant for individuals' residential status. As you can see, category 2, 3 and 4 are for very specified person like Indian citizen or person of Indian origin, but the first category is for everyone. If you don't come in category 2, 3, 4, then you have to go by default in category 1 only. Okay. Now, when a HUF will become resident, very simple, an HUF will become resident if the control and management is wholly or partly in India. It means if it is wholly outside India, then it will become what? It will become non-resident. When an HUF will become ordinary resident, can an HUF also become ordinary? Yes. If the Karta is ordinary, then HUF ordinary. If the Karta is not ordinary, then HUF is also not ordinary. Remember, only individuals and HUFs can become ordinary resident. Rest all are either resident or non-resident. For example, when a firm, AOP, BOI, trust, etc., cooperative society, they will become resident if the control and management same is wholly or partly in India. It means if the control and management is wholly outside India, then they are non-resident. Now again the question will come over here, can they also be called as what? Can they also be called as ordinary? No, no, no. Firm, AOP, BOI, they cannot be called as ordinary. They will be either resident or non-resident. The concept of ordinary resident is not applicable to them. They will be either resident or non-resident. I hope it is clear to all of you. Now let's talk about the most important residential status out of all of them, that is residential status of a company. When a company will become resident, now there are two clauses which are given over here under section 6(3). First, if you are an Indian company, then you are by default a resident. Okay. Indian company means the company which is registered or incorporated in India, that will be called as Indian company. And if you are registered or incorporated in India, then by default you are a resident. Okay. Close your eyes and say resident. What about foreign companies? Can foreign companies which are incorporated outside India, can they also be called as resident? Yes. If their poem in that year is in India, then they will be called as resident. And if their poem in that year is not in India, then they will not be called as resident. Sir, poem means what? Poem means, the definition of poem is given under section 6(3) as it's a place where key management and commercial decisions are taken in substance. So if a key management and commercial decisions of a company are taken in India, even though the company is located outside India, it is incorporated outside India, but the key management and commercial decisions are taken in India, then that company will be called as what? Resident in India. Okay. Now I hope it is clear to all of you till here. Okay. Now to explain this concept of poem in a better manner, CBDT has given a very important guideline, and this guideline is very important for your exam. One of the most important part for your exam is this guideline only. Now first of all, you need to understand that this guideline is not applicable for all foreign companies. You need to first of all understand one thing, that this guideline and poem is not applicable to Indian companies. Indian companies are by default resident. It is applicable to foreign companies whose place of effective management in India, they can also become resident. So this guideline is also for a foreign company who can become resident because of the poem in India. Okay. Now this guideline is only applicable, this guideline is not applicable to all the foreign companies. It is only applicable if a turnover of that foreign company is more than what? Is more than 50 crore in the previous year 24-25. So previous year 24-25 is the relevant previous year for us. So in the previous year 24-25, if your turnover is more than 50 crore, then this guideline is applicable. Otherwise, this guideline is not applicable to you. Okay. Now, as per this guideline, all the companies are divided into two categories. First category is called as where active business is outside India. If active business is outside India, then your poem is outside India. And if your poem is outside India, then you are non-resident. Okay. And if your active business is not outside India, then what to do, that we will see after some time. So first of all, we will talk about where the active business is outside India. So for that, what am I supposed to do, sir? If your active business, again I am saying, if your active business is outside India, then your poem is outside India. And if your poem is outside India, then you are by default non-resident. So you have to fulfill some conditions if you want your active business to be called as outside India. So how many conditions we are supposed to fulfill? For that, the government has given 4 monetary conditions and 1 general condition. Total 5 conditions you have to fulfill if you want to become a non-resident. If you fulfill 4 conditions, your active business will be considered to be outside India. And if you fulfill the 5th condition, you will be called as what? Non-resident as per the income tax law. So every foreign company would wish to fulfill these 5 conditions so that they should become non-resident in India, because if they become resident in India, then world income will be taxable in that case. Therefore, what is the first condition? So if all the following conditions are fulfilled, then your active business is outside India, your poem is outside India, and you are a non-resident. First, your passive income should be less than equal to 50% of total income. Now you need to be very careful. In the first condition, they are using the word less than equal, but in the next 3 conditions, they are using the word less than 50%. So in the first condition, even if it is 50% of total income, it is fine. But in the next 3 conditions, if it is exactly 15%, then the conditions will be violated. You need to be as minute as this while reading a provision. Okay. I hope it is clear to all of you. So your passive income should be less than equal to 50% of total income. So what does passive income include? Passive income includes 2 types of income. First, when you purchase from associate enterprise and sell to associate enterprise, then whatever profit you earn, whatever income you earn, that is your passive income. Both purchase and sale should be from associate enterprise. Now, if I purchase from associate enterprise and sell to non-associate enterprise, then that will not be called as passive income. If I purchase from non-associated and sell to associated, that will also not be called as passive income. For passive income, your purchase and sale both should be from associate enterprise. You can check this point over here. Point number 2. Royalty is passive, capital gain is passive, dividend is passive, rental is passive, interest is passive. Even though you earn from associated or non-associated, it doesn't matter. These 5 incomes are always passive. But in this also there is an exception. For banks and financial institutions, interest will not be considered to be passive income. For them, it will be called as a total. It will be called as an active income. I hope it is clear to all of you. Now, what is the second condition? Your 50% of the assets, less than 50% of the assets should be in India out of the total assets. So you need to find out the total asset, take the total assets in the denominator and take the assets which are there in India in the numerator and check whether it is less than 50% or not. If it is less than 50%, condition is fulfilled or it is violated. How to value the assets? For depreciable asset, you take the average at the beginning and at the end of the year and for other assets you take the book value. Okay, so for depreciable assets you will take the depreciable value as per the taxation. If tax is not there, you can take the accounting values. First priority has to be given for depreciable assets as per tax. Take the WDV, and if the tax values are not there, then you can take the accounting values. For non-depreciable assets, you can take the book values. Third condition, your less than 50% of the employees are situated in India or resident in India. Therefore, the employees which are situated in India or which are resident in India should be less than 50%. So take your total employees in the numerator and take the employees which are situated in India or which are resident in India in the numerator, and take the total employees in the denominator and check whether it is less than 50% or not. How will I count the number of employees on which date? Again, you will take average at the beginning and at the end of the year. 1st April, 31st March, divide by 2, take the average as per that. Will employees also include contractual employees? Yes. Employees will not only include the employees which are on your payroll, but will also include those employees which are working on a contractual basis, which are not on your permanent payroll, but they are also functioning like an employee. You have to consider that also. Plus, the employees which are in India, then their payroll expense should also be less than 50% of the total expense. Okay, so all those employees which are there in India or which are situated in India or which are resident in India, their payroll expenses should also be less than 50% of the total expense. Last but not least, if you fulfill these 4 conditions, one last condition you have to fulfill is majority of the board meetings should be held outside India, provided the board has the authority to make such decisions. Majority of the board meetings are held outside India. Out of 10, 6 board meetings should held outside India. Out of 5, 3 board meetings at least should held outside India. But the board should have the power not to make decisions outside India. For example, if the board is keeping majority of board meetings outside India, but major decisions are taken from India only, then this condition is violated. So majority board meetings should be held outside India means the board should have the power to take that decision. Otherwise, it's of no use. If majority of board meetings are held outside India, but still 2 meetings are held in India out of 10, but that 2 meetings are taking all the big decisions, then this condition is violated as per the income tax law. Plus, if holding company makes policy for everyone, for all the subsidiaries across the world, then it cannot be said that the board does not have power, because that is not specific to any company, that is specific to the entire group. So in that case, you cannot say that the condition is violated. So all the data which you have told us to take, that should be for how many years? Generally, if it is available, then take average of current year, that is 24-25, and last 2 years if data is given. If 3 years data is not given, you can take a shorter period also, that is also allowed. Okay, it is allowed to take a shorter period also if 3 years period is not given. Now, if you fulfill all the conditions given over here, then your poem is outside India. If your poem is outside India, then you are non-resident in India. But if you violate any of the condition, then you need to come to the second case, that is companies other than ABOI. It means the companies who do not fulfill the active business outside India case, active business outside India condition, then what has to be done in that case? Then there are multiple conditions that the government has given. Stage 1, identify the person who makes key management and commercial decision, and identify the place where decisions are made, where you are sitting and taking the decision. That place might be the place of effective management. Now these are all subjective points. These are all very, very specific points, because there are numbers over here. There cannot be manipulation, there cannot be litigation over here. But here there can be litigation, because these are all subjective points. So if you do not fulfill the ABOI test, then you need to find out the person who makes commercial decision, the place where commercial decisions are taken. Plus, important point, the place where commercial decisions are implemented are not important. The place where it is taken, it is important. Suppose I am sitting in Bombay and I am taking decision that I want to invest in Singapore, then Singapore is not relevant for me. Bombay is relevant. Singapore is the place where the decision is implemented. Bombay is the place where decision is taken. The place where decision is taken is more important than the place where decisions are implemented. I hope it is clear to all of you. The CBDT has given further other guidelines, like you need to find out the location of the board meeting. You can also find out if the board of directors have delegated the authorities to some committee, then where are those committee members are based, and are they taking key management and commercial decisions? If yes, then where the committee members are based, that country will be called as the place of effective management. Further, location of head office can also be important to determine what? The place of effective management. Then residence of director is also important these days. Where directors are residing, there is no need to have a physical presence in these days to have some meeting or conferences. Everything can be done what? Through a video conference. Therefore, the residence of the director is also important to determine what? The residential status, the poem. Then circular resolution. If a circular resolution, which is also called as round robin voting, if that is passed by a company, then who is eligible to pass that? Who has the authority to pass circular resolution? That person. Where is that person located? That person's location can also be important to determine the residential status. Then location of strategic shareholder. Generally, shareholders are not important into taking management and commercial decisions. because the entire objective of company is formed with a basic concept of management is different, ownership is different. Generally, shareholders are not relevant to determine the commercial and management decision. But if the shareholder is a strategic shareholder, that is 20, 30%, 40% shareholder, then his role will be important to determine what key management and commercial decision. In that case, find out the location of the shareholder. Then some other guiding factors. If all these guiding factors are also not giving conclusive results, then the government has given some other guiding factors that find out where substantial activity of the company is taken, find out where the accounting records of the company is kept. If substantial activity is taken in India, then India can be country of POEM. If accounting records are kept in India, then India can be considered as country of POEM. Last but not least, they are again mentioning no single principle will be relevant. You need to determine the POEM based on facts and circumstances of every case. You cannot just say that because of one of the guiding factor, we will say that the POEM is in India. No. You cannot say because of one of the guiding factor, the POEM is in India. You need to find out in entirety where is the POEM. No single principle can be decisive. Just because the foreign company is owned by an Indian company, you cannot say the POEM is in India. Just because the directors are residing in India, you cannot say the POEM in India. Just because the local management or liaison office, what is liaison office? I'll be talking about that in a while, is in India. You cannot say the POEM is in India. Now, who will determine whether the POEM is in India or not? The AO has to collect all these evidences against SSC and prove it that the POEM is in India. For that, the AO will initiate the proceeding with prior approval of CIT, will give a show cause notice, and then the AO will find out finally that the POEM is in India or not by passing an order, and he will take an approval from a collegium. A collegium will be formed of group of 3 CIT, which will be nominated by the chief CIT. So first he will initiate the proceeding by taking an approval from CIT, and then he will complete the proceeding by taking an approval from a collegium. I hope it is clear to all of you till here. Now, after this particular concept of POEM was introduced in around 2016-17 by the government of India, there were a lot of questions which were asked with respect to the residential status of the POEM. When a foreign company will become resident for the first time, a lot of questions were asked. So to address that question, CBT has issued a notification in 2018, 29/2018, and they have addressed all the questions over here. The first question was, a foreign company, suppose it is located in United Kingdom, UK. Now, if that company is becoming resident for the first time in previous year 24-25, now what about the assets on which they will going to, because now listen carefully, it's a very, very important notification. If a foreign company which was non-resident in last year, in the current year, they are becoming resident because of the POEM. Now, because of the POEM, if they are becoming resident, their world income is taxable in India. So now, if their world income is taxable in India, they are eligible for depreciation also in India. So what is the amount of WDV on which they will claim depreciation? Because they were not maintaining books of accounts in India, they were not liable to tax in India till last year. Now in the current year, they are liable to tax in India. So what is the amount of WDV on which they are going to claim depreciation? So for that purpose, the government has given this notification. Point number 1, there are many other points in this notification. We are starting with the issue of depreciation first. The first thing is, we need to find out the country in which the foreign company is located, whether that country has tax or not. If that country has a taxation law, then the treatment is different. If that country does not have a taxation law, then the treatment is different. So if that country has a taxation law, then we need to ask whether depreciation is allowed as deduction to them over there. If yes, whatever is that WDV on the first day, as per the tax record, that will become the WDV in the income tax law. For example, this is previous year 24-25. This is the year in which the company became resident as per POEM in the first year. This is the first year of residential status because of POEM. So WDV on 1/4/2024 will become what? The WDV as per the tax record on 1/4/2024 will become what? Will become the WDV in India in the current year. Okay. If there is no tax over here, if there is a taxation over there, but depreciation is not allowed to that company over there. Listen carefully. There is a taxation over there, but depreciation is not allowed because of some reason. Say maybe because that company might be following some presumptive income, etc. Therefore, depreciation is not allowed to that company over there. Then we need to compute the WDV as per the tax record of that country as per 1/4/2024, and that will become the WDV in the income tax law, and you can claim depreciation in the current year. Third possibility, if there is no tax only over there, if there is no tax only, then you need to take the WDV on the first day as per the books of accounts of the foreign country, and not as per tax, because if tax is not there, then you need to take the value as per the books of accounts. Second point, what will happen with brought forward loss and UAD? You need to be very careful with this particular issue. Again, the brought forward loss, previous year 24-25 is the first year in which the company is becoming resident. If there are losses in 23-24, 22-23, 20-21, 21-22, 19-20, 18-19, 17-18, what will happen with those losses? All of them will be carried forward and set off. Don't worry, as per the rules mentioned over here. First of all, If the losses are as per tax, then it will be carried forward and set off as per tax. If the if the tax is not there in that country, then the losses will be carried forward as per what? As per the books of accounts. Okay. Now, for how many years they will be allowed to carry forward? They will be allowed to be carried forward for against what? They will be allowed to carry forward for the balance number of years, not for another 8 years. If there is a business loss of 2021-22, then 8 years will count from 21-22, not from 24-25. Then if a business loss is there of 2010-11, then the business loss of 10-11 will not be allowed to carry forward because the period of 8 years have gone. Moral of the story is very simple. Losses will be allowed to carry forward for the balance number of years. What about UAD? UAD will be allowed for what? UAD will be allowed obviously for infinite number of years. For UAD, there is no limit under the income tax law. Now, one of the most important point is point number D. Against what this loss and against what this UAD can be set off. That you need to be very careful. This losses and this UAD, which is coming from United Kingdom to India for the first time in 24-25, this can be carried forward and set off only against income which are accrued outside India and income which are received outside India. It cannot be carried forward and set off against an Indian income which is accrued in India or income which is received in India. This can only be set off against the income which is accrued outside India and income which is received outside India. I hope it is clear to all of you. Now suppose there is a loss of 22-23 of 10 lakh rupees which I brought in India and I set off that loss. Now in the foreign country, the foreign tax authority are revising that loss to 8 lakh rupees. Is it possible? Yes, in foreign country there is a reassessment opening and because of that the loss of 10 lakh has been reduced to 8 lakh. So am I also supposed to change in India? The answer is yes. If there is a revise or modification of loss in foreign authorities, as per the foreign authorities, then even in India, you have to change that particular loss under the income tax law. I hope it is clear to all of you. Now, one of the biggest problem that we are going to encounter over here is about, I'm going to tell you now. Pay attention please all of you. I will also give you an example to explain the next concept. Now, next concept is about this point number F. Pay attention on this point number F very carefully. Listen to me very carefully. We have done all these things in great detail in our class. Don't worry. This is just a revision to just brush you up again and again so that you watch this again and again in full English and recall that in your mind. Okay. Now listen carefully please all of you. Generally what happens? India, we follow financial year from April to March. But it may not happen that the foreign company is also following the financial year. What if the foreign company is following financial year? If it is following financial year, then there is no issue. Previous year 24-25 is the first year in which you have become resident. Previous year 23-24, losses will be carried forward for 8 years. Previous year 22-23, losses will be carried forward for 7 years. Previous year 21-22, losses will be carried forward for how many years? 6 years. There is no issue. If our financial year and financial year of foreign company matches, there is no issue. The issue will come when we follow financial year from April to March and they follow some other years like calendar year from Jan to December. Then what will happen? In that case, we need to find out that previous year 24-25 is the year in which the company has become resident. Now, we need to find out their last year. Suppose their last year is Jan to December. Now, if their last year is Jan to December, then we need to find out which is that Jan to December. It is obviously Jan 23 to December 23. Okay, because then the last year is Jan 23 to December 23. Then you need to find out the interim period between this. What is the interim period between this? If the interim period between this is less than 6 months, it is how much? It is less than 6 months. The law says that this period should be clubbed with this Jan 23 to December 23 and you should make one financial year of that particular year. So in this case, your one financial year will be Jan 23 to March 2024. I hope it is clear to all of you. So because this interim period is less than 6 months, you will make Jan 24 to March, Jan 23 to March 24, one single year and then 7 years before that. What if this interim period is more than equal to 6 months? If it is more than equal to 6 months, then you will consider this to be a separate financial year and this to be a separate financial year. I have given us example over here. You can check this example over here. I hope it is clear to all of you. Now moving to the next point, point number 3. This foreign company is a foreign company. The answer is yes. Is this foreign company also a resident company? The answer is yes. Because of poem, it has become resident. Now, if somebody makes payment to this company, whether they should deduct TDS as per 194J or 195, because in 194J it says written that if you make a payment to resident, you are supposed to deduct TDS, and in 195 it is written if you make a payment to foreign company, you are supposed to deduct TDS. So what should I consider this company as? You should consider this company as a foreign company and deduct TDS not as per 194J but as per 195 only. Okay, I hope it is clear to all of you. Now this foreign company has become our resident. if the foreign company has become resident of India, then is India going to give them unilateral and bilateral relief under section 90 and 91? The answer is yes, India will give them unilateral and bilateral relief under section 90 and 91. So whether this company, next point, let's move on to the next point, whether this company is going to get the benefit of this carry forward of losses, carry forward of UAD, depreciation for the subsequent years also. Yes, for the subsequent year also, this company is going to get the benefit of all those things which we have seen over here. Okay, next. Suppose if in some provision it is specifically written that this section is only applicable to resident, then whether this company will come under that. Obviously, this company is a resident. Therefore, all the provisions under the income tax law where it is specifically written that it is applicable to resident, this company can enjoy that benefit. Similarly, if any section in which it is written that this company is specifically applicable to foreign company, whether this company will enjoy that. Obviously, this company is also a foreign company. Nobody can deny the fact that this is not a foreign company. This is definitely incorporated outside India. It is a foreign company. Therefore, they can enjoy this section also. Suppose if there is a section which says that this section is specifically applicable to NR, then whether this provision will be applicable, then this company cannot take the benefit of that particular section, because this company now cannot call itself as an NR. Yes, it is a resident. Yes, it is a foreign company, but it cannot call itself as a non-resident now, because it has become resident because of the poem. Last but not least, sir, what will be the tax rate? Whether they will be liable for tax as per domestic company or foreign company. The tax rate will be as per foreign company only, that is as per 35%. I hope it is clear to all of you. This is where we complete the entire discussion of what? The residential status. Now there is a small issue under section 285 regarding submission of some statement by non-resident having license office in India. Now what is a license office? Generally, if a non-resident wants to start with a business in India, they will generally open one small office in India to do some research and development, etc. They are not opening the office to do the business. Business they will do in future. Now they are just doing some R&D, whether India is a good economy or not to invest, whether which area to invest, what are the taxation policies, what are the government policies, what are the competitors. For that, a non-resident opens what? A license office in India. Now, whatever they have done in the entire year, they have to give the details to the assessing officer within a prescribed time. So the government has said that they have to deliver all these things within such period. A statement in such form containing as may be prescribed. The government will prescribe the period within which it has to be given. So whatever activities the non-resident has done in the entire year in the license office, they have to give a statement of that. And if they don't give the statement, they'll be liable for a penalty of 1,000 rupees for the first 3 months, and then later on 1 lakh rupees. Opportunity of being heard will be given. So for the first 3 months, 1,000 rupees every day, the penalty will be imposed, and after that, a penalty of what? 1 lakh rupees will be imposed on you. Opportunity of being heard will be given to you. I hope it is clear to all of you. Now let's move on to the next part. That is, a small clarification is given by CBDT on a non-resident seafarers, all those who travel in sea, that is a crew member of a Indian ship. For them, there is a small clarification that if they receive their salary in a bank account in India, in an NRI account, which account? If they receive their salary in a non-resident external account, then that is exempt. Now this is applicable for whom? All those who are non-resident seafarers, who are traveling in sea, and if they receive in India, in bank account in India in a non-resident external account, then it is exempt. If they receive in non-resident ordinary account, NRO account, then it will be taxable. It is only exempt if it is received in NRE account, not in the NRO account. Okay, I hope it is clear to all of you. Now let's move on towards the next part, which is very big part of your discussion and one of the most important part of this chapter, that is interest, royalty and FTS. Along with that, we will also talk about the taxability of dividend. So we need to talk a lot of things about interest, royalty and FTS and dividend. First of all, we need to talk about when interest is accrued, when royalty is accrued, when FTS is accrued. Then what is the tax rate, what are the TDS rate, what all deductions will be allowed to us, so on and so forth. Okay, so now the very first thing that we need to understand over here, when interest income is accrued in India, that is given under section 915, and 915 says that if interest is payable by government, then it is accrued in India. If Indian government has taken loan from somebody outside India, say from World Bank, then that interest is accrued in India, because Indian government will be making the payment to the World Bank. Okay, similarly, if a resident in India takes a loan from a non-resident and makes a payment to them, then that is also accrued in India. But for point number 2, there is an exception. That is, if I am a resident and if I take a loan from a non-resident, if I use that money outside India for the purpose of business and profession, or if I use that money outside India for the purpose of other purposes, then the interest which I am going to pay you, that will not be deemed to accrue or rise in India. Therefore, for point number 2, it is very clear. if a resident takes a loan and if that money is used in India for business purpose or for other purpose, then only the interest will be accrued, otherwise it is not accrued. You can check it over here. I hope it is clear to all of you. Okay. Now the third point is when an interest is payable by NR. For example, a US person has given a loan to a UK person. Now a UK person is giving loan to the interest to the US person. So US person given loan to the UK person, UK person giving loan to interest to the US person. Whether that interest will be accrued or not, again that depends upon where that loan money is utilized. If that loan money is utilized in India for the purpose of business or profession, then the interest is accrued in India. But if that loan money is used in India for other purpose, okay, for any other purpose other than business and profession, then it is not accrued in India. I hope it is clear to all of you. Okay. So it all depends upon where that UK person is using that loan. If he's using that loan in India for business and profession, then the interest is accrued in India. If he's using that money in India for buying some debentures of company, shares of company, it means for other purpose, then that interest will not be accrued in India. I hope it is clear to all of you. Similarly, in interest also there is one exemption over here. If an individual is receiving interest on money standing in his NRI account, if an individual, I am an individual, I am receiving some interest on the money which is lying down in my NRI account, it is exempt. But this is only exempt if you are an individual who is a person resident outside India as per FEMA. You should be non-resident as per FEMA, or you should be a person who has been permitted by RBI to maintain such amount in the account. Okay. So either you should be a person non-resident as per FEMA, or you should be permitted by RBI to maintain such accounts in India. Then the interest which is lying in the NRI account, that will be what exempt in your hands. I hope it is clear to all of you. Now for FTS also, for FTS and royalty, for royalty the section is 916 when royalty income is accrued in India. For FTS the section is 917, but both of them are almost same only. That is the reason we are going to address both of them together. Now the first point and the second point and this exception is exactly same like what? Is exactly same like interest. So I'm not talking about that once again, it doesn't make sense. Now the third point is different from interest. Now listen carefully. Suppose a US person is giving some services, is selling say for example a computer software to a UK person. Now a UK person is giving that royalty to the US person. Whether that royalty is accrued in India or not, it all depends upon where that software is used. If that software is used in India for business purpose, for profession purpose, or for any other purpose, then that royalty will be taxable in India. And if that software is used outside India for business purpose, profession purpose, or any other purpose, then it is not accrued in India. So how this point is different? This point is different from interest, because for interest, when a non-resident pays interest to another non-resident, it is only accrued in India if the money is used in India for business and profession. But for royalty and FTS, not only business and profession is mentioned, but also for the purpose of earning or making any other income. Now this particular sentence which I am highlighting, this was not there in interest. This is how interest is different from what? Royalty. I hope it is clear to all of you. Now there is one explanation attached below section 9 to explain something about royalty, FTS and interest. It's a clarificatory explanation. Generally what happens, let me tell you. Generally what happens, if you want to charge a business income of a non-resident in India, then the non-resident should have a business connection in India, or a non-resident should have a permanent establishment in India. Otherwise, a non-resident's income cannot be taxable in India. A non-resident's income is taxable in India only if there is a business connection or only if there is a permanent establishment in India. Otherwise, it is not taxable. But further, a non-resident income is taxable in India only if they render services in India. They have to come to India and render the services here. Otherwise, it is not taxable. But for royalty, interest and FTS, there is an exception which has been created in explanation 9 to section 40 to section explanation to section 9, which says that in case of interest, in case of royalty, and in case of FTS, there is no need to have any business connection. There is no need to have any permanent establishment. There is no need to render services in India. The only condition is the services should be utilized in India. You have to fulfill whatever is written in section 915, 916 and 917. That's it. There is no need to have a separate branch or separate office or separate factory or any other fixed place of business in India to tax these items in the hands of non-residents. So non-residents, these incomes will be taxable irrespective of whether they have a business connection or permanent establishment in India, irrespective of whether they are providing services in India or not, whether they are rendering services in India or not. Only important is the services should be utilized in India. Rendering can be done from outside India, but utilization should happen in India. That is much more than sufficient. I hope it is clear to all of you. Now we are going to talk about the taxability of interest and dividend first, and then we will talk about the taxability of royalty and FTS. First, I am going to talk about taxability of interest, and then I will talk about taxability of dividend, and then I will talk about taxability of royalty and FTS. In interest, there are 4 different kinds of sections which are covered over here. There are 4 different types of interest which are covered over here in 115A. Now I am going to talk about all of them one by one. It's a matter of little bit of by hearting. You have to by heart these things at your end. First of all, the first interest, who is the lender? Non-resident and foreign company. Non-resident and foreign company is the lender. Second interest, who is the lender? Again, non-resident and foreign company. I'll do first 2 sections first and then the third and the fourth one. So in the first section, the lender, and the second section, the lender is same, non-resident foreign company, non-resident foreign company. In the first section, who is borrowing? The borrowing is done by Indian concern. Indian concern is not Indian company. Don't be misunderstood by the word Indian concern that it means Indian company. No, Indian concern will include Indian company also, other businesses also. Anybody who is doing any business and profession in India will be called as Indian concern. Next, government. The borrower is government. In the second section, the borrower is infrastructure debt fund, whose income is exempt under section 1047. Section 1047 exempts the income of infrastructure debt fund. In the first section, the tax rate is 20% plus surcharge if applicable, plus cess always. In the second section, the tax rate is drastically lower, plus surcharge if applicable, plus cess. 5% plus surcharge if applicable, plus cess. In the first section, TDS will be deducted under 195 sorry. In the second section, it will be deducted under 194 LB. Time limit, there is no concept of time limit anywhere over here. Unlike the third and the fourth section, in the third and the fourth section, there is a concept of time limit. Here, there is no concept of time limit. No approval required, no approval required from anybody. The interest rate will be discussed between the buyer and between the borrower and the lender. The borrower and the lender can decide the interest rate. The government will not interfere in the interest rate. Okay. Next, instruments, loan in foreign currency. Instrument will be what? This is very important. In the first section, the loan will be given in foreign currency. The lender will give you the loan in foreign currency. In the second section, the lender will give you the loan in the any currency. Check it, please. Now let's move on to the third and the fourth section. The third section is the most dangerous one. The fourth section is very easy. In the third section, who is the lender? The lender is non-resident or foreign company. Who is the borrower? The borrower is only Indian company. Be very careful. And in the third section, there are multiple tax rates. Sometimes it is 5%, sometimes it is 4%, sometimes it is 9%. I'll teach you all of them when it is 5, when it is 4, when it is 9%. Okay. The TDS is deducted under 194 LC. Now, let me show you when it is 5%, when it is 4%, and when it is 10%. Let me show you. If you are borrowing money from outside India, in a foreign currency, the money has to be borrowed in foreign currency. The condition of third section, the money has to be borrowed in foreign currency. Okay. And it has to be borrowed on or after 1st July 2012. But before 1st July 2023, and the money should be borrowed in 3 forms. Either it has to be in the form of a loan, either it has to be formed in the long-term bonds, or either it has to be formed in the form of a rupee denominated bond. Okay. So if you have borrowed the money, listen carefully. From outside India, condition number 1, if you have borrowed the money in foreign currency, if you have borrowed the money between this period and in these 3 forms, then your tax rate is 5%. Okay. Now, coming to when the tax rate is 4% and 9%. Now the 4% and the 9% case is only applicable to a bond or rupee denominated bond which is listed in a recognized stock exchange. If you are borrowing money from outside India, that is on or after 1st April 2020 but before 1st July 2020, buy a long term bond or rupee denominated bond listed on a recognized stock exchange in India, then it is 4%. So if you borrow between this period and it is listed in a recognized stock exchange in IFSC, then it is 4%. And after, if you borrow after 1st July, that is on after 1st July, then all the conditions are same only, then your tax rate will be 9%. I hope it is clear to all of you. So for general people, case 3 is applicable. For IFSC located bonds and IFSC located rupee denominated bond or long term bond, case 1 and 2 is applicable. Then depending upon the period, it is 4% or it is 9% as the case may be. I hope it is clear to all of you. Now. One more thing that I need to say over here. If you borrow the money through rupee denominated bond, between the period, listen carefully. If you borrow the money through rupee denominated bond between the period from 17 September 2018 to 31st March 2019, then your interest is fully exempt as per 10(4)(c). You can check over here. If you borrow the money through what? Rupee denominated bond between the period from 17 September 2018 to 31st March 2019, then it is fully exempt as per section 10(4)(c). No TDS will also be applicable in that case. I hope it is clear to all of you. Now, in the third section, there is what? Your rate of interest should not exceed the approved rate. The government will decide the rate of interest. It should not exceed that particular rate. In the fourth section, the rate of interest should not exceed the approved rate. Fourth section we will talk after some time. Okay. But in the first 2 sections, you need not have to check the rate of interest. You need not have to check the rate of interest to be approved by government. In the first and the second section, the rate of rate will be decided between the borrower and the lender, but not in the third section. Okay. Last but not least, I have already told you, you have to take loans in third section, long-term bonds in foreign currency or rupee denominated bond, which can be in any currency. Okay. Now coming to the last section over here. In the last section, who is the borrower, who is the lender? Lender is changing now. Check FII, QFI, which is approved. The lender has to be foreign institutional investors or qualified foreign investors, and both of them should be approved. Similarly, the lender will give money to whom? The lender will give money to Indian company or to government of India. What is the tax rate? The tax rate over here is 5% flat. Is there any period here also? Yes, there is a period over here between, it has to be after 31st May 2013, but before 1st July 2013. But here the timing is not of taking the loan, the timing is of interest payable. If its interest is payable between this period, then this section is applicable. Otherwise, this section is not applicable. So according to me, this section is not much relevant for your exam. The reason is because if interest is payable in this period, then this period does not fall in the period of 24-25. And for us, the relevant exam, the relevant previous year is what? 24-25. For us, this section would have been relevant if we would have come under 24-25. Otherwise, this section is of no use. Okay. I hope it is clear to all of you. Here also, it should not exceed approved rate. And here the nature of security are what we are going to issue to the non-resident or foreign company, what we are going to issue to the FIIs and QFIs. We are going to issue rupee denominated bond. We are going to issue government security and also municipal debt securities you can issue. For municipal debt security, the time limit is slightly different. It is not from 2012. It is from 2020 to 2023. For rest of the two, the time limit is from 2013 to 2023. So for government security and for RDB, for rupee denominated bond, it is 31st May 2013 to 1st July 2023. And for municipal debt security, it is 2020 to 2023. I hope it is clear to all of you. Last but not least, point number 5, what does it say? If a non-resident has given loan to a unit in IFSC on or after 1st September 2019. Suppose you are non-resident, I am located in IFSC, you have given me a loan, I am paying you an interest, and if the loan is given on or after 1st September 2019, then whatever interest I am paying you, it is fully exempt under section 1015. I hope it is clear to all of you. Now last but not least, what is the dividend income tax? How is the dividend income taxable in case of non-resident and foreign company? Now that depends from where you are getting the dividend. If you are getting a dividend from a unit in IFSC, then the tax rate is 10%. If you are getting a dividend, if the non-resident or foreign company is getting the dividend from a unit in IFSC, then it is 10%, and any other case it is 20%. Now it is flat 10%, 20%. No deductions are allowed out of this. Generally, if you take a loan to invest in shares, then you get a deduction of 20% of the interest. 20% interest is allowed as deduction under IFOS, but that deduction is not available to non-resident and foreign company. For non-resident and foreign company, dividend is directly taxable at 20% or 10% as the case may be. Now, some very important questions that we need to answer one by one. Sir, this interest income and against this dividend income, are we going to get any deductions? So let me tell you, no PGBP deductions will be allowed against this interest. No IFOS deductions will be allowed against this interest. No unabsorbed depreciation will be allowed against this interest. Whether can I claim chapter 6A deduction? No chapter 6A all deductions also allowed against this deduction, this income, except ATLA. ATLA is the only chapter 6A deduction which is allowed against this income. Otherwise, no other chapter 6A will be allowed against this income. Sir, am I supposed to set off the losses of other business against this business income? Can I set off the losses of my other business taxable in India against this interest income? Yes, that is allowed. If you have other businesses in India, you can set off that loss against this income. That is allowed under the income tax law. Sir, am I supposed to file the income tax return? No need to file the income tax return if you fulfill two conditions. First, if you earn only the above special income and your TDS is deducted at a rate not less than the rate mentioned in 115A. What is the rate mentioned in 115A? It is sometime 20%, sometime 5%, sometime 4%, sometime 9%. If it is deducted as per the rate mentioned in 115A, no need to file the return. But yes, if in DTAA the rate is lower, then you have to apply that rate. Suppose in income tax law the rate is 20% and in DTAA it is 18%, then you have to deduct TDS as per 18%. So in that case, the assessee is liable to file the return. But if the TDS is deducted as per 115A rates, whatever rates are mentioned over here, if it is deducted as per this rates, then there is no need to file the income tax return if you earn only this income. I hope it is clear to all of you. So whether these incomes will be liable for MAT for the foreign company, again, if your tax rate is less than the MAT rate. What is the MAT rate? MAT rate is 15%. If your tax rate is less than 15%, then you're not liable for MAT. But if your tax rate is more than 15%, or equal to 15%, then you are liable to MAT. Therefore, in the first case, my tax rate is more than 15%. Therefore, I am liable for MAT. And in the second, third and fourth case, my tax rate is less than 15%. Therefore, I am not liable for MAT. I hope it is clear to all of you. Now, this completes your interest and dividend. Now, let's talk about royalty and FTS. For royalty and FTS, similar section is applicable, but there are two sections applicable for royalty and FTS. Remember all of you, if there is no PE of the non-resident in India, then you will come under 115A. And if there is a PE of a non-resident in India, permanent establishment, the non-resident or foreign company has a permanent establishment in India, then you will go under 44DA. But to come under both the sections, the non-resident should have an agreement with the Indian concern or government, and that agreement should be approved by central government. If the agreement is not there or it is not approved, then you do not come under both the section, then you will go under the normal provisions of the income tax law. 115A is also special and 44DA is also special. To come under both the sections, there needs to be an agreement which is approved by central government. If there is a good agreement which is approved by central government, then you will come under either 115A or 44DA. Then check whether PE is there or PE not there. If PE is not there, then this section is applicable. If PE is there, then you can go to 44DA. But if you don't have agreement only, or if the agreement is there, it is not approved only, then you don't come under both the section. You go under the general provisions of the income tax law and pay the tax according to that. Now, coming to 115A, the royalty and FTS will be taxable if the non-resident and foreign company does not have a P in India. So, if the non-resident and foreign company is giving some services to government in India or Indian concern, then the non-resident foreign company will be liable to tax at the rate of 20% or DTAA, whichever is lower. Okay, 20% or DTAA rates, whichever is lower. Again, if the tax rate is less than 15%, then the MAT is not applicable on the foreign company. If the tax rate is more than equal to 15%, then the MAT will be applicable on the foreign company on royalty and FTS also. Okay. Now, having an agreement and approval from central government is mandatory. If you do not fulfill these conditions, then you will be taxed as per the normal rates. Now, which all deductions I will be allowed? No PGBP deductions will be allowed against this. No IFOs deductions will be allowed against this. Whether I will be allowed carry forward and set off of losses? Yes, if you have some other businesses, you can set off that loss against the income of what? Royalty and FTS covered under 115A. Whether am I supposed to file the ROI? Again, same condition. If you only have earned this income and your tax is deducted at a rate not less than 115A rate. If the tax is deducted as per 20% of this section, then there is no need to file what? There is no need to file any kind of ROI. Whether Chapter 6A is available from above income? The answer is yes. In the previous case, in interest, the Chapter 6A was only allowed against what? 80LA income, not against all income. But here, Chapter 6A is allowed against all incomes. So this point is different from what? Different from interest. I hope it is clear to all of you. And last but not least, suppose there is an organization by the name called as National Technical Research Organization in India, and there is a non-resident and foreign company who is sitting outside India. Now that National Technical Research Organization is providing services to non-resident and foreign company in India, and in return we are what? We are paying them some money in the form of Indian government is paying them money in the form of interest and in the form of royalty and FTS. Whether that will be taxable, so that is exempt under the income tax law under section 106D. So who is providing services? Non-resident foreign company. Who is availing services? Indian government in the form of National Technical Research Organization, NTRO. They are providing some, they are taking the payment of FTS and royalty to whom? To non-resident. Then that is exempt under the income tax law. Okay. Now, the definition of royalty is given under section 9, and the definition of FTS is also given under section 9. It is given in a very inclusive manner. There are a lot of points under that is not much relevant for you because it's an inclusive definition. It's not an exhaustive definition. But yes, below the definition they have put 3 explanations. That is absolutely important for you for your exam. One by one we are going to decode all the 3 explanations. First of all, explanation number 4 is what? I am in India, you are outside India. If you are giving me some rights of computer software, what are you giving me? Rights to use the computer software, then that is royalty, and according to that, the rights of that computer software is royalty, and I am supposed to deduct TDS under section 195 in that particular case. But, what is rights to software, sir? Rights to software means you are giving me the know-how of the software, how to make that software. With the help of that right, I will do that. I will make software and I will then sell the software to others. So I will reproduce software by taking the know-how from you. That is the right of software. And therefore, in that case, that is an expense in my hand. And in my hand, if it is an expense, it will not be added to the block of asset. I am not going to claim depreciation on that particular software. In fact, that is a revenue expenditure to me and it is subject to TDS. But as against this, there is another thing. Suppose if I buy a computer software from you, I don't buy the rights of computer software, but I buy the software from you for 2 purposes. Either to resell it without doing any modification, or either for my end use. In my business, I want to use that software for some purpose. In that two cases, the Supreme Court of India, in the case of Engineering Analysis Center of Excellence Private Limited versus CIT and another, has held that that is not royalty. That is a purchase of software, and that should be added to the cost of asset, and you can claim depreciation on that. This is not royalty. So you need to understand the difference between what is a software rights and what is actually a software. Okay, what is the use of software rights? With the help of that right, you will make multiple software. And what is the use of computer software? In as per the Supreme Court judgment, computer software will be either sold directly without making any modification, or it will be used for your business as an end user. Okay, I hope it is clear to all of you. Another explanation is for banking industry and credit card industry. Now there are multiple people over here. Suppose there is SBI over here and there is a customer of SBI. The customer of SBI has taken some SBI credit cards. Now every time the customer will go to the retail shop, he will swipe the card. The card will go for verification in the server. Now suppose the server belongs to Bank of Germany in Germany. Now every time the card is swiped by the customers of SBI, the server will verify that particular transaction and will tell the retailer that the card is approved, the PIN is approved, the amount balance is sufficient, and therefore the transaction can be conducted. Now at the end of the year, the German company whose server the SBI is using, the German company will raise an invoice on SBI, and SBI has to make the payment. The question is whether that amounts to royalty or not, and the answer is yes. Explanation 5 says that yes, that is a royalty, and therefore the TDS has to be deducted under section 195 by the Indian bank, that is SBI. So when SBI will make the payment to Bank of Germany, they have to deduct TDS under 195. Similarly, explanation 6 to section 9. What does it say? The Indian TV channels. Lot of Indian TV channels, if they want to transmit their programs on the television, they have to make use of what? They have to make use of the satellites of the foreign company. Yes. So if they are making use of the satellite of the foreign company, they have to make the payment also to the foreign company in the form of some amount. Whether that payment made to the foreign company for use of the satellite, whether that amounts to royalty or not, and the answer is yes. Explanation 6 to section 9 says that yes, it is a royalty. TDS has to be deducted under section 195. I hope it is clear to all of you. Is it clear? Now let's go ahead with the next point. As I have told you, for royalty and FTS, there are two sections, 115A and 44DA. Now we are going to talk about comparison of 115A as well as 44DA. 115A is applicable if non-resident does not have a P in India, and 44DA is applicable if non-resident has a specific branch in India, that is a permanent establishment. In 115A, we do not get deduction of any expenses, but in 44DA, you can claim all expenses. Don't worry about it. But certain expenses are not allowed. First, if your expense is not wholly and exclusively for the Indian branch, suppose if there is a common expenditure, you have taken an asset on which the Indian branch is also claiming depreciation, the foreign HO is also claiming depreciation, then that is not allowed. The expenditure has to be exclusively for the Indian branch, then only it is allowed. The allowance has to be exclusively for the Indian branch, then only it is allowed, otherwise it is not allowed. Second case, if I take services from my HO and if I make payment to them, then that is also not allowed. The reason is, if an HO is providing you services and you are making payment to them, that is as good as payment to self only. Head office and branch and one and the same thing. Therefore, that is also not allowed under the income tax law. But if you have taken services from some third party and you are making payment to HO and you are telling them to make the payment, that is, you are doing the payment in the form of a reimbursement. You are not making the payment actually to HO. You are just making HO an agent who will reimburse your payment on behalf of you. In that case, that is allowed as deduction, as you can see over here. Okay, again I am saying, if an expenditure is not exclusively for Indian branch, it is not allowed. If a service is taken from HO, you are making the payment to HO, not allowed. But if service is taken from third party, your HO has made a payment to the third party and you are reimbursing that payment to HO, then that is allowed under the income tax law. Next, chapter 6A, allowed in both the cases. Losses of other business allowed to set off in both the cases. Yes, the next 2-3 points are very specific. In 115A, there is no need to maintain any books of accounts, but in 44DA, you are supposed to maintain books of accounts as per 44AA. In 115A, there is no need to do any tax audit, but in 44DA, you are supposed to compulsorily do audit. And in 115A, the tax rate was 20%. Here, the tax rate will be the actual tax rate. There is no concession of tax rate in 44DA because you are getting deduction of expenses. So in the tax rate, you are not going to get any concession. If you are a foreign company, the tax rate will be 35% plus surcharge if applicable, and cess. And for other associates, the tax rate will be as per the respective slab rates or whatever is the tax rate applicable to them. Okay. So this is where we complete all the discussion of what? Royalty and FTS. Now, one small explanation is there for Indian branches of a foreign bank. Suppose there is Bank of America, which has an Indian branch in India. Let me give you an example. This is Bank of America, headquarters in USA. This is Bank of America, Singapore branch. This is Bank of America, Indian branch. Now, if they want to give loans in India to consumers in India, from where they are going to get the money, the head office will give them loan and the Singapore branch will give them loan. In return, they will pay them what? Interest. They will pay them what? Interest. Now, whether this interest is allowed as deduction to them, the CBDT has said that yes, it is allowed as deduction. But at the same time, CBDT has said that if this interest which you are paying to your HO, to your other branches on loan taken from them, if it is allowed as a deduction to you, then that interest should also be taxable in the hands of the respective person. The corresponding person should also pay tax on that now. Therefore, the Bank of America, Indian branch, while making the payment of interest to their HO or while making the payment of interest to their other branches on loan taken from them, they have to deduct the TDS. And if they don't deduct the TDS, then in that particular case, they will be called as assessee in default and action will be taken against them and levy of interest, penalty, etc. will be imposed on them. I hope it is clear to all of you. Now let's move on to the next section, that is 115AB, then 115AC and 115AD. We will deal with all of them one by one. 115AB. Who is the assessee over here? Assessee is Overseas Financial Organization. Who is an Overseas Financial Organization? It's a non-resident who has taken permission with SEBI, Securities Exchange Board of India, to invest in India, and it has an arrangement with Public Sector Bank in India. And where are they investing? It's a non-resident who has taken an approval from SEBI to invest in India, and they have an arrangement with Public Sector Bank. And where are they investing? Now they are purchasing UTI and mutual fund in foreign currency. What are they purchasing? Units of UTI and mutual fund in foreign currency, and whatever income they will earn out of it, that is if they earn some dividend income, that will be taxable at 10%, and if some long-term capital gains income, that will be taxable at 10%. Okay. Now this 10% is applicable till 22nd July. From 23rd July, this 10% will become how much? This will become 12.5%. There is an amendment made here also. Along in capital gains also they have made an amendment now. From 23rd July, the long-term capital gain is changing to how much? 12.5%. So here also the long-term capital gains is changing to 12.5%. Now, will I get any deduction? No deduction. Will I no deduction of any PGBP, IFOS or Chapter 6A? Nothing will be allowed. Whether first proviso to Section 48 will apply? Not apply. What is first proviso to 48, sir? Which we have done in the chapter of capital gains. That is, you have to do TTBR, TTSR of the transaction. That will not be applicable over here. What is second proviso? Second proviso to 148 is you're talking about indexation. Even indexation is not allowed over here till 22nd July also. From 23rd July to nobody gets indexation ever. Set off of losses, yes. If you have some other losses, you can set off against this business. Exemption from filing ROI, no. You have to file the return of income. There is no escape from filing of return of income. Return of income is mandatorily supposed to be filed. Okay. Now coming to the second section, which is very important for exam also. First section is not very important. Second one is very important. Second section 115AC. There is a non-resident and foreign company. The assessee is non-resident foreign company. What are they buying? They are buying bonds of Indian company. They are buying bonds of public sector undertaking, and they are buying what? GDR. And all of them are supposed to be in what? In foreign currency. It is very important that all of them are supposed to be in foreign currency. Here also till 22nd July the tax rate is 10%. From 23rd July the tax rate has become 12.5%, for which there is an asterisk over here. You can see over here. Okay. From 23rd July the tax rate has become what? 12.5%. Interest and dividend income will be taxable at 10%. TDS will be deducted under 196C. In the previous section, TDS is deducted under 196B. Rest all is same except the last point, exemption point, which is different. How rest of the points are same, sir. No deductions will be allowed. The first proviso not applicable, second proviso not applicable. Losses, if there, you can set off against this income. And exemption, yes. Are you getting exemption from filing ROI? Yes. If you fulfill two conditions, no need to file ROI. First, if you earn only interest income and TDS is deducted, if these two conditions are fulfilled together, then there is no need to file any return. Now, I would like to do some great discussion on one of the points mentioned over here, that is global depository receipts. I need to do detailed analysis of the discussion on global depository receipts, which I have done over here. So I'll be talking about global depository receipts in detail now. What is global depository receipts and what are its tax implications? There are three tax implications which are covered over here. Before that, I will explain you what is global depository receipts. Suppose there is a company in India by the name called as Infosys. Now suppose Infosys wants to raise money from outside India, then it has to issue GDR in foreign country. It has to issue GDR in foreign country with the help of a local bank in foreign country. Suppose Infosys is an Indian company, and if it wants to raise money from London, that is from UK, then it has to get into an arrangement with a UK local bank which will work like a depository, and that UK local bank will raise money for Infosys in India, okay, in foreign country, and that money will be brought to India. Now, First of all, the income tax only recognize GDR of listed company. First thing you have to keep it in mind. Income tax does not recognize GDR of unlisted company. That is the reason I am taking what? Example of what? Example of Infosys, because Infosys is a listed company. So Infosys being a listed company wants to raise money from UK. Now suppose Mr. A, Mr. A has bought one GDR, for how much? Say he has bought 100 GDRs for 1000 rupees. How many? 100 GDRs for 1000 rupees. Now the tax implication number one is, if one non-resident transfers GDR to another non-resident, if one non-resident transfers GDR to another non-resident outside India, but with GDR which is mentioned in 115 AC, it means it has to be a GDR of a listed company, then such transfers are exempt under the income tax law. Check it please. It means if you transfer the GDR of a listed company, NR to NR outside India, it is exempt, but if you transfer the GDR of unlisted company, then it will be taxable. I hope it is clear to all of you. To understand the further things, let's take an example. Suppose 100 GDRs are purchased by Mr. A non-resident on 15th April at the rate of how much? At the rate of 1000 each. Therefore, how much money he has paid to the company? He has paid 1 lakh rupees to the company on 15th of April 2023. Now, if it transfers this GDR to another non-resident outside India, and if it is belonging to listed company in India, then such transfer is exempt under section 47 7A. But if it does not transfer this, and if it tells the government of India, I want to trade in Indian stock market. Now to trade in Indian stock market, GDR are not traded in Indian stock market. If you want to trade in Indian stock market, you need to buy and invest in shares. So you can make a request to the Indian government. You can make a request to the company that please redeem my GDR and give me shares. So suppose you made a request. Request for redemption was made on 15th of September 2023 for conversion of GDR into shares. And on that day, one share of the FMV of one share of Infosys was 2,200. And suppose you made a request and after that the company has allotted shares to you after 2 months, that is on 15th of November. On that day the value of one share was 2,400. Now I am giving GDR and in exchange getting shares. Whether this will be taxable? The answer is obviously yes. Giving GDR and taking shares is exchange. Exchange includes, transfer includes exchange. Therefore this will be taxable. So now the question is, what will be the FVC? The FVC will be the FMV of the shares on which the request for redemption was made. What was the request for redemption made? The request for redemption was made on 15th September. What was the FMV on that date? The FMV on that date was 2,400. Therefore, how many shares you have got? I have got 50 shares in exchange of 100 GDR. Therefore, that will become my sale consideration. 2,200. What is 2,200? FMV on the date on which request for redemption was made into 50 rupees. That will be my sale consideration. Okay. And cost of acquisition, I know the GDR is purchased for 1,000 rupees. 1,000 into 100. This will become my short-term capital gains. Now, what do I have? I have 50 shares of FMV. 50 shares of listed company Infosys. Later on, if I sell them for 3,000 rupees per share, now how will the capital gains be computed? Selling price will be 3,000 into 50 shares. This will be a my sale consideration. The two questions which will arise: what will be the cost of acquisition? The government has said that in that case, the cost of acquisition will be the cost, the FMV of the share on the date on which the request for redemption was made. That is again the date, that is on 15th September, whatever is the value, that will become your cost. From when I will count the period of holding, whether the asset is long term or short term, the period of holding will also be counted from here only. That is, the asset is long term or short term. The period of holding will also be counted from 15th of September 2023 only. Check it please. The period of holding will be counted from 15th September till 1 day prior to the date of transfer, and the share value will also be 2,200, and therefore the differential amount will be long term or short term as the case may be. I hope it is clear to all of you. So this is the taxability of GDR. Now let's come to the third section, that is 115AD. What is 115AD? 115AD covers two things. First, it covers FIIs, and then it covers certain specified fund about which we are going to learn later on in section 10.4D. The taxability is different for FIIs and the taxability is different for specified fund. According to that, you need to answer the things. First of all, what they will buy? They will buy any security other than 115AB. Other than 115AB, they will buy any security in any currency. There is no need to be foreign currency. To come under 115AD, you need not purchase foreign currency securities. Any kind of security other than 115AB. What is covered in 115AB? Mutual funds are covered. Except mutual fund, they will buy everything. That is, they may buy what? They may buy shares, they may buy debentures, they may buy equity shares, they may buy preference shares, they may buy debentures, they may buy bonds, they may buy any damn thing in this world except what is covered in 115AB. And in that case, if there is a long-term capital gain, then that is subject to 10%. Now this 10% is not changed to 12.5% by the government of India. Be very careful. This is the only case in the entire income tax law, that is 115AD. in which the government has not increased the limit to what? 12.5%. It is still remaining 10% only. So normal long-term capital gains will be taxed at 10%. Normal short-term capital gains will be taxed at 30%. Now special capital gains under 111A will be taxed at 15% till 22nd July, and from 23rd July it will be 20%, which is mentioned below in the form of an asterisk. And normal long-term capital gains will be 10% in 22nd July, and from 23rd July it will become what? 12.5%, and you are going to get an aggregate deduction of 1.25 lakhs in the entire year. Even if you transfer before or after, it doesn't matter. Even if you transfer before 23rd July, the aggregate deduction will be 1.25 lakhs. Even if you transfer after 23rd July, the aggregate deduction will be 1.25 lakhs. Now, what is the tax rate for interest? For FIIs, tax rate, interest and dividend will be taxed at 20%, and for specified fund, the tax rate is slightly lower, it is 10%. Now, if your interest is covered in 194LD, because what? FIIs are also covered in 194LD na. What 194LD you are talking about, sir? We are talking about this particular section. FIIs are covered over there or not in this particular fourth section of 115A. If you are covered over there, then you will be paying tax as per that only, because there the tax rate is 5%. Rest all are same as what? Are same as the first section, that is 115AB. Now there is one more catch over here which you need to keep it over here. That is, if you want this concessional rate, then the FIR or specified fund should have the units should be held by the non-resident. Suppose there are 100 unit holders of the FIIs, out of which 70% units are held by non-resident, 30% are held by residents. Then in that case, only 70% of the income will be subject to this concessional tax rate. Remaining 30% income will be subject to not this concessional tax rate. Remaining 30% will be subject to normal tax rate. So be very careful. If the FII want to enjoy these special tax rates, then 100% unit holders have to be held by the non-resident. If 70% is held by non-resident, then out of the entire income, only 70% will be subject to concessional tax rate, and remaining portion will be subject to normal tax rate. You can check this over here. This is the formula given by the Government of India as far as the FIIs are considered. I hope it is clear to all of you. So let's go ahead with the next section. That is a special chapter specially made for non-resident Indians. It's a special chapter, chapter 12A. Now whatever special tax rates we have done so far now, 115A, 115AB, 115AC, 115AD, all of them were covered in chapter 12. Now this is a special chapter, chapter 12A, specially made for non-resident Indians, which is covered under section 115C to I. Okay. Now, in this, first of all, we need to understand the definitions of certain term which is given under 115C. What is the meaning of NRI? NRI means you should be an individual. You should be an individual. Then, at the same time, you should be either citizen of India or you should be person of Indian origin. And as per income tax law, you should be non-resident. You should be non-resident as per section 6 of the income tax law. So, you should be individual. Then you should be citizen of India or person of Indian origin, either of the two. And at the same time, you should be non-resident. Plus, you should purchase certain specified assets. What are the specified assets? There are 4 assets which are covered in the definition of specified asset. First is shares of Indian company. Both public and private company shares are covered. Okay. Public company shares are also covered. Private company shares are covered. But debentures of only public limited company, debentures of private limited company are not covered. Deposits of only public limited company, deposits of private limited company is not covered. The institute plays with all these words in the exam. Be very careful. And then government security. Now, the NRI has to buy these assets in foreign currency, only in convertible foreign exchange, only then it will become foreign exchange asset. And unless and until NRI buys these assets in convertible foreign exchange, you will not be covered under this particular chapter. Okay. Then you should earn long-term capital gains out of this, and then you should also earn investment income, which will include dividend and interest income from the foreign exchange assets. So these are some of the definitions that you have to keep it in mind. Now this chapter is optional. If you want to come in this chapter, come. If you don't want to come in this chapter, don't come. That is absolutely your choice. Nobody is forcing you to come to this chapter. Okay. Now once you come under this chapter, how will you compute the income? No deduction of PGBP, no deduction of IFOS, no deduction of chapter 6, and nothing is allowed. Nothing is allowed against these incomes. But first proviso to section 48 is available over here. It means when you purchase the shares, etc., or debentures or bonds, etc., in foreign currency, then you have to do all those things, all those calculations of converting first into, as per TTBR, then into foreign currency, then again into Indian currency. You have to do all those calculations. Second proviso not applicable. Indexation benefit is never available under this chapter, even before 23rd July. After 23rd July, indexation is not available on any case except one case where indexation is available. No other case indexation is available from 23rd July. Other income will be charged at normal rate. Now, what is the tax rate? The normal capital gains is increased to 12.5%. The special capital gains covered under 112A is also increased to 12.5%, and you will also get an exemption of 1.25 lakhs aggregate in the entire financial year from this financial year, that is 24-25. So if you transfer before 23rd July, it is 10%. If you transfer after 23rd July, 12.5%, and then you will get a total exemption of 1.25 lakhs in the entire year. Okay. Now, interest income, dividend income will be taxed at 20%. Other incomes will be taxable at normal rates. Now, what is one of the main reason that a person will opt for this chapter? As I've told you, this is an optional chapter. You can check over here, 1155. This chapter is optional. If you want to come, come. If you don't want to come, don't come. That is absolutely your choice. But why a person will come? A person will come over here because of the exemption given under 1155. 1155 says that whatever long-term capital gains is coming, you can get entirely exempt if you reinvest the net consideration, not the gain. If you reinvest the net consideration within 6 months in the specified assets. So within 6 months from the date of transfer, if you invest the net consideration in the specified asset means any of these 4 assets, within 6 months if you invest, then the entire capital gains will be exempt. But if you don't invest the entire net consideration, but you invest the part of the net consideration, then proportionate capital gains will be exempt to the extent of long-term capital gains into cost of new asset that divided by net sale consideration. That much will be exempt, fully will not be exempt. If you want your full capital gains to exempt, you need to reinvest the entire net consideration within 6 months from the date of transfer. Now, when you purchase the new asset, there is a lock-in of 3 years on the new asset. You cannot sell the new asset within 3 years. If you sell the new assets within 3 years, then whatever capital gains was exempt earlier, that will be taxable. That will be added to your income, and capital gains chargeable on the new asset will be separately charged on you. Okay. Now, am I supposed to file the income tax return? There is no need to file the income tax return. If you earn only this investment income, that is interest and dividend income or capital gains income, and your TDS is deducted, then there is no need to file the income tax return. Last but not least, so today I am non-resident Indian, but if tomorrow in the next year, if I become resident, then will this chapter continue to apply to me? Yes, this chapter will continue to apply to you even if you become resident in the subsequent year, till the time you don't redeem your debentures or bonds or whatever is covered in this particular section, deposits, etc., whatever is covered. Okay. So that is what this chapter is all about. This is one of the most important chapter of the entire syllabus. So please pay attention very carefully on this chapter 12A. Now coming to the next point, 115BB, lotteries are taxable. Lottery, winning from lottery, crossword, puzzle, horse race, card games, any other game, gambling, betting, all of them will be taxable at 30% without any deduction. For resident also it is 30%. For non-resident also it is 30%. It is 30% for everybody. Okay. Now 115BBJ is a new section inserted by Finance Act 2023, which talks about winning from online games, about which we have already done a great discussion in the chapter of TDS revision. You can go and check over there the TDS revision, which we have already recorded in full English for you all. Okay. So that is also subject to 30% flat tax without any deduction of any expenses. Now we are going ahead with the next part of this particular chapter, that is we are going to talk about the exemptions under section 10 for non-residents. So there are around 50 clauses in section 10, but we are not going to talk about all of them today. We are only going to talk about those exemptions which are covered under section 10 for non-resident. For example, the first section over here is section 1048. What is section 1048? This is applicable to a foreign company. What should a foreign company do? They should be engaged in sale of crude oil or any other goods or services as notified by the central government. Has the government notified any other goods and services? No. As of now, there are no other goods which are notified over here. Only sale of crude oil is covered. So, who is the assessee over here? Foreign company is the assessee. What is the assessee doing? It is selling the crude oil. To whom it is selling? It is selling to any person in India. Resident, non-resident, doesn't matter. It should be sold to any person in India. Yes, but the money should be received in India and the money should be received in Indian currency. And that company, foreign company, should not be engaged in any other activity in India. It should only be engaged in sale of crude oil, not any other activity in India. And there has to be an agreement with the central government, and that agreement should be in national interest of India. If all these conditions are fulfilled, then the income from sale of crude oil of foreign company is exempt under section 1048. Now, 1048A is also a similar section, but let's see how this section is different from the previous one. Here also foreign company is there. In the previous section also foreign company is there, but there is a difference. Here also you are selling crude oil. Here also you are selling crude oil, but there is a difference. In the second section, 1048A, you are storing the crude oil in India and then you are selling from there. You are first storing. In the first section, you are not storing in India. You are directly selling from outside India. But in this second section, you are storing the crude oil first in India and then you are selling from there. Second, in this section you are selling to Indian resident. In the first section you are selling to any person in India, but here you are supposed to sell only to Indian resident. In the first section the money should be received in India in INR. In the second section the income should be accrued in India. It can be received outside India also. It can be received in foreign currency also. There is no these two conditions are not applicable in the second section. In the first section there is one more condition, that the assessee should not be engaged in any other activity in India. In the second section there is no such condition. It means in the second section the assessee may be engaged in what? Other activities also in India. I hope it is clear to all of you. And last condition is same. The assessee should be engaged in what? Agreement. There should be agreement with central government, and that agreement should be in the national interest. I hope it is clear to all of you, these two sections. Now, the third section is a continuation of the second section itself. In the second section, you have entered into an agreement with central government to store the crude oil in India, and then you will sell it. Okay. Now, the third section is a continuation of second section. Third section and the fourth section has nothing to do with the first section. Now, how third section is a continuation of second? Suppose you have entered into an agreement with central government for 5 years, and the agreement expires after 5 years. Now, some leftover stock is there. Now, if I sell that agreement, if I sell that stock of crude oil after the agreement has expired, whether that will also be exempt? The answer is yes, that is covered under 1048B. Sale of leftover stock in India after the expiry of the agreement, that is also exempt under 1048B. Now, the fourth one. Suppose if I enter into an agreement with the central government for 5 years that I will store crude oil in India for 5 years and then I will sell. Suppose after 2 years I terminate the agreement with central government. I do what? I terminate the agreement with central government, and after termination if I sell it, whether that will also be exempt? The answer is yes, that will also be exempt over here. The government has been very lenient as far as this particular provision is considered. Okay. Now some technical discussion we are going to do with respect to section 10, not very important for exam. Let me tell you very honestly. The very first one is section 10(4)(e). What is 10(4)(e)? If you are a non-resident, and if you earn any income, how? By transfer of 3 items: non-deliverable forward contract. Who are you? You are non-resident. What are you doing? You are earning some income. What income? Capital gains income. How you are earning? By transferring non-deliverable forward contract or offshore derivative instrument or over-the-counter derivative. It means you are earning capital gains by transferring these 3 items, 1, 2 and 3. Then your capital gains will be exempt. Okay. Second, if you earn some distribution of income out of it, it means you earn some dividend or interest out of it, then that is also what? Exempt over here. Okay. Provided you should enter into a contract with whom? You will enter into this contract, non-deliverable forward contract with whom? With an offshore banking unit of an IFSC, and which fulfills such other condition as may be prescribed. What other conditions they are supposed to fulfill? They are supposed to fulfill some procedural condition like that offshore banking unit should hold a valid certificate or registration granted under IFSC regulation, and such contract or instrument of derivative is not entered into by a non-resident through or on behalf of its PE in India. So they are supposed to fulfill certain conditions which are prescribed by the law under Rule 21AK. What is the first condition? They need to have a valid certificate registration, and such contract is not entered on behalf of its PE. So that contract is not entered on behalf of its PE in India. That contract is directly entered by non-resident from outside India, not on behalf of its PE in India. I hope it is clear to all of you. Similarly, 10(4)(f) exempts the income of non-resident by way of royalty or interest on account of lease. So if the non-resident is giving an aircraft or ship on lease, to whom? To a unit of an IFSC. So the non-resident is giving aircraft or ship on lease to whom? To a unit of an IFSC. Then it is exempt under income tax law. The royalty and interest, whatever it will be earned by the non-resident, that will be exempt under the income tax law. I hope it is clear to all of you. Now the third section, 10(4)(g). Again, non-resident. A non-resident is sitting outside India and he is earning income from where? Portfolio of securities or financial product or funds managed or administered by a portfolio manager on behalf of such non-resident. Now listen carefully. A non-resident is sitting in United Kingdom. He is a resident of UK. He is sitting in United Kingdom, and there is a portfolio manager in India who is managing his portfolio. The portfolio manager is in India and the non-resident is outside India, and the portfolio manager is managing his portfolio. He is selling, buying, selling the shares of that non-resident. In what? In Bombay Stock Exchange? No. In Nasdaq, in New York Stock Exchange, in London Stock Exchange, in Dow Jones, not in India. Then the income of that non-resident will not be liable to tax in India. That is what it is mentioned over here. You can check over here. To the extent such income accrue or deemed to accrue outside India, the income should not accrue in India. So the non-resident is outside India. The manager is in India. Where is the manager? The manager should also be located in where? In the IFSC. Plus one more item the government has added over here. First one was portfolio of security or financial product or funds managed or administered by any portfolio manager on behalf of such non-resident. One more item they have added, such activity as carried out by such person as notified by central government. So has the government notified any other activity? Yes, the government has notified that income received by non-resident from the activity of investment in financial product by the non-resident in accordance with a contract between non-resident and capital market intermediary being a unit of IFSC would also be exempt over here. So who is the assessee over here? Non-resident. From where he is earning the income? From the activity of investment in portfolio product by non-resident in accordance with contract between non-resident and capital market intermediary being a unit of IFSC, that will also be exempt under the income tax law. Now all these points are not very important for examination. Yes, it is there in the syllabus, so we are doing it. Not very important for examination. I'll tell you which sections are important out of 10, out of section 10 for your examination, which ICI targets again and again. Next one, capital gain on exemption. Capital gain exemption to unit of IFSC subject to following condition. Suppose you are a transferor and you are a non-resident. You are a transferor, you are a non-resident, or you are a unit of IFSC. You are a unit of IFSC engaged primarily in the business of leasing of aircraft. So either who is assessee? The assessee is a non-resident or a unit of IFSC. What is the assessee doing? Assessee is engaged in leasing of aircraft. Now, if you transferor generates capital gains from transfer of equity shares in the domestic company being a unit of IFSC. Now, if the assessee who is mentioned in condition number 1 has equity shares of another company who is located where? In IFSC, and that company is also engaged in leasing of aircraft, and if you transfer the shares of those company, if you transfer the shares of this company which is also engaged in what? The company is first of all located where? In IFSC. The company is engaged in what? The company is engaged in leasing of aircraft, and you hold the shares of what? Those kind of companies, and you are selling those shares, then you are exempt for the first 10 years. It will not be taxed for the first 10 years. For 10 years, if within 10 years, if you transfer the shares, those are not subject to tax. I hope it is clear to all of you. The next point is related to capital gains. Whenever capital gains will start, at that point of time, I will be addressing this concept of original fund and the resultant fund. It is linked to that particular concept. So today I am not speaking about that. Let's move on to the next point. That is section 10.6.2 and section 10.6.6. This is very important for examination. As I have told you, remember these 2 points for exam. These 2 points are extremely important for your CA final exams. Rest of the section 10 exemptions are not very important for exam. Now what is this section all about? This section talks about an individual who is not a citizen of India. Suppose US citizen is there. It is not for Indian citizen, it is for foreign citizen. A US citizen works in a US embassy in India. A US citizen works in a US embassy in India. Now who will give him salary? US government will give him salary. Now whatever salary US government is giving him, that is exempt in his hand, subject to 2 conditions. First condition, our government gives salary to our citizens in USA, yes or no? In US also there will be what? An Indian embassy, and Indian government will give them what? Indian government will give them salary, yes or no? So they should exempt our salary, they should exempt our salary of our employees, then we will exempt the salary of US employees. I hope it is clear to all of you. So if the Indian citizens are getting exempted under the US tax laws, then the US citizens will get exemptions under the Indian tax law. Second, that US citizen who is working in the embassy should not be engaged in any other business, should not be engaged in any other profession, and should not be engaged in any other employment. He should not be engaged in any other business, profession or employment. He can have a bank account, he can earn interest, he can have a house property, earn rental, but should not be engaged in business, profession or employment. Any other business, profession or employment they should not be engaged into. If he fulfill these 2 conditions, then the income of the individual who is a foreign citizen will not be subject to tax in India. I hope it is clear to all of you. Now section 10.6.6. What is this? I'll explain you this with the help of an example of Tesla company. Tesla is a foreign enterprise. This section is applicable to a foreign enterprise, and there is an employee of Tesla who is a foreign citizen, who is a US citizen. This section again applies to a US citizen, foreign citizen, not only US citizen, any foreign citizen. It applies only to foreign citizen. It does not apply to Indian citizen. Now suppose Tesla is sending its employee to India for some research and development, and it is paying some salary to the employee. For the time being he was there in India. Now that income is accrued in India, but the government says that that employee will not be subject to tax in India, subject to 3 conditions. First, Tesla should not be engaged in any business or trade in India. Tesla should not be engaged in any business or trade in India. Second, the employee stay in India for how many days? 90 days. Up to 90 days if the employee stays in India, it is okay. And the third condition, in future whenever the Tesla will start the business in India, Tesla should not claim the deduction of this remuneration paid to him under the income tax law. Tesla should not claim deduction of this remuneration in India under the income tax law. If these 3 conditions are fulfilled, Tesla will be exempted. The employee of Tesla will be exempted from paying tax. The remuneration will become exempt in the hands of the employee. I hope it is clear to all of you. Now let's go ahead with one last exemption which is given under section 1023 FE, but this one last exemption is biggest of all the exemption. Now in this case, the exemption is given to certain specified person. First of all, we need to know who are specified person. Now there are three category of people who have been covered under specified person. So let us try to understand the three category of specified person first of all. Specified person number one is covered under point number A. It is an wholly owned subsidiary of Abu Dhabi Investment Authority, resident of UAE, makes investment directly or indirectly out of the funds owned by the government of Abu Dhabi. So there is a government of Abu Dhabi, under which there is an Abu Dhabi Investment Authority, and under which there is a wholly owned subsidiary whose parent is Abu Dhabi Investment Authority, and the money is given by whom? By the government of Abu Dhabi. So the wholly owned subsidiary, it means in short the government of Abu Dhabi is investing in India. The government of Abu Dhabi is nothing but the specified person. The second specified person over here has to fulfill certain 5 to 6 conditions. Second specified person is called as sovereign wealth fund. They have to fulfill 6 conditions over here. First of all, it should be wholly owned by the government of foreign country. Second, it should be set up under the law of foreign country. Third, its earnings are only credited to the government of foreign country and not to any other private person. Its earnings. So whatever will be earned by the sovereign wealth fund, which will be given only to the government of foreign country and not to any other person. Plus, on dissolution of that particular fund, all the assets will go to the government of the foreign country and not go to any third person. But in these two conditions, they have put one relaxation, that if the government has taken a loan from somebody or taken something on credit, then definitely they have to make the payment to creditors and depositors for that particular loan. Okay. Obviously, now you cannot say that we will not repay the loan also, because the condition says that we should not give any portion of our earning to any third person. If you have taken a loan, then you have to pay interest now. If you have taken something on credit, you have to pay that money. You have to pay that money now. That condition you can violate for the purpose of making the repayment of loan or for the purpose of making the payment of creditors. Okay. Now that fund, that sovereign wealth fund, does not participate into the day-to-day operations of the investee. Investee means it is the company in which you are investing in India. That sovereign wealth fund should not poke their noses every day that what are you doing, how are you investing, how are you raising the money, where are you investing. You should not get into day-to-day management of the company. But yes, to protect their investment, they have the right to appoint directors, they have the right to appoint executive directors, and that will not be considered as what? Poking nose into the day-to-day operations of the investee. Okay. Last but not least, that fund should be notified by the central government and it should fulfill such other condition as notified by the government of India. Plus, who is the third category of specified person? Pension fund, and the pension fund has to fulfill 5 conditions. First of all, the pension fund is created under the law of a foreign country. The pension fund should be created where? Under the law of foreign country, just like the sovereign wealth fund. Secondly, the pension fund should not be liable to tax in any country. The pension fund should not be liable to tax by that foreign country. Okay. Even if it is liable to tax, it should be exempted by tax law. It should not be liable, it should not pay tax out of his pocket. They have to fulfill such other conditions as may be fulfilled, and the 4th and the 5th conditions are same as the previous section. That is the pension fund only. That is the sovereign wealth fund only. So this conditions 3A and 4 was also there for the sovereign wealth fund. Now coming to the most important point. This was the specified persons whose income is exempt under section 1023 FE. Now we need to understand which incomes are exempt. First of all, dividend income will be exempt, interest will be exempt, and then section 56(2)(12). What is 56(2)(12)? Business trust income. Which income? Business trust. We will learn in the chapter of business trust. Business trust income will be exempt, and last but not least, long-term capital gains income will be exempt. By what? By making what? By making investment in India in the form of a debt, in the form of a share capital, or in the form of a unit. From debt, they will earn what? Interest. From share, they will earn what? Dividend and capital gains. And from unit, they will earn what? Again, dividend and capital gains. Okay. Now, the investment also has to be made between April 20 to March 24. There is a period given by them. And the investment should be held for a period of how many years? It should be held for a period of 3 years. 3 years. This is the minimum lock-in that they have to hold. If they sell before that, then it will be liable to tax. I hope it is clear to all of you. Now, coming to the next point, where they should make investment? In India. But in India, in which company? In which entity? So there are 5 different cases where they have said that, see, we know that they will make investment in debt, they will make investment in equity, they will make investment in business trust units. But which company is debt? Which company is equity? Which company is business trust? That we need to answer over here. So first of all, they will make investment in business trust, and business trusts are formed for what? Real estate purpose. Second, point number B is the most important company for us. In the second case, they will invest in a company or enterprise who are engaged in infrastructure facility in India, who are engaged in the business of developing, operating and maintaining infrastructure facility or such other business as may be notified by central government, but the government has not notified anything. So as of now, in point number B, there is only infrastructure company which is covered. Okay. So first they will invest what? In business trust. From that, they will will earn some what dividend, interest, long-term capital gains, that will be exempt. Second, they will invest in a company which is engaged in what? Which is engaged in maintaining, developing and operating infrastructure facility in India. Okay. Now, what is infrastructure facility? You can go to section 35AD. Whatever we have seen in the definition of 35AD, that same infrastructure facility is covered over here. Now, the third point is very interesting. You will now invest in category 1 and category 2 AIF. Where you will invest? You will invest in alternative investment fund. The specified person will invest in alternative investment fund. And what kind of alternative investment fund it should be? That investment fund should invest not less than 50% of investment in B company, in D or in E category company. So this investment fund in which you are investing now, they should invest at least 50%, not less than 50%. At least 50% of their money should be invested in B, D or E category company. I hope it is clear. Similarly, point number 4, you should invest in, the specified person will invest in a new domestic company which is incorporated on or after 1st April 2021. It should be a new domestic company, and that new domestic company should have 75% investment in this B point company. That domestic company should invest 70% of its funding where? In the infrastructure company mentioned in B. And the last one is NBFC, and that NBFC should give 90% of its funding to whom? To the B category company. So every dots are joining to what? Joining to B category company. So C is also investing in B, D is also investing in B, and E is also investing in B. Now all these people have to invest mostly in B category company only. Now last few points which I would like to address over here. You are supposed to fulfill the conditions to get the exemption. Now in future, if you violate any condition, then whatever exemption you have claimed earlier, that will be subject to tax. So what do I mean by violate any condition? Violate any condition means if you sell the units, if you sell the shares, if you sell the debt, if you sell the debentures within 3 years, then all these exemptions which you are getting, that will be subject to tax. That will be reversed over here, as you can see over here. And one last proviso is given over here, that also I would like to address you all. Now see, that is also very important. To claim exemption, you have to invest. The C category has to invest at least 50%. Now, if they invest 70%, they will be exempted. If this D category invests how much? 75%, they are exempted. But if similarly, if NBFC gives 90% of the lending to B category company, they are exempted. But the catch is, if they exceed the threshold, they will get exemption, but only proportionate exemption. If they want full exemption, then they should give the entire money to them. Then only they will get full exemption. Let me explain you with the help of one example. Let's talk about the C category company. Suppose this has invested 70% in B category company, and the total interest earned by them is how much? 1 lakh rupees. Then only 70% of the interest will be exempt. Only 70,000 interest will be exempt. 30,000 will be taxable. If they want their entire interest to be exempt, then they should not only invest 50%, but they should invest 100% in B category company, C category company, D category company, E category company. Then only they will enjoy the exemption. Otherwise, they are not going to enjoy the exemption. I hope it is clear to all of you. Not very important section. Again, this was not a very important section, but the next one is absolutely important for your exam. So many times they have asked this particular exemption, this particular section in your examination. That is 115BBA, a special tax rate which is applicable to non-resident sportsmen, non-resident sports association and non-resident entertainer, where they are going to pay tax at the rate of flat 20% plus surcharge if applicable and cess. Let's talk about non-resident sportsmen first. If you are a non-resident sportsman, as well as you should not be a citizen of India. If you are an Indian citizen, this section is not applicable for you. This section is only applicable to foreign citizen. At the same time, you should also be non-resident. And if you participate in any game or sport in India, other than 115BB, that lottery, etc. are not covered over here. Other than like chess is covered, cricket is covered, other games are covered, other sports are covered, but lottery, etc. is already covered at 30% tax. And if you participate in any event or any game or any sport in India, you are covered over here. Or if you do advertisement and earn money, it is covered. Or if you give contribution in any article or newspaper or journal relating to sport in India, then also that is covered over here. Similarly, a non-resident, point number B, who is covered in point number B? A non-resident sports association is earning income from India. Suppose International Cricket Council is a non-resident sports association, and BCCI, Board for Cricket for Control in India, it's an Indian Cricket Association. Now, whatever matches are organized in India, for that BCCI has to pay some money to ICC, because ICC is allowing India to host the matches, and therefore whatever payment is made by BCCI to ICC, that will also be subject to tax over here at the rate of 20%. Similarly, if in India a non-resident who is not a citizen of India and is an entertainer like Coldplay, like Justin Bieber or any other Shakira or foreign country, foreign citizen who is coming to India, who is a non-resident for entertaining people in India, they will also be subject to 20% flat tax over here. Sir, will they get any deduction from their income? No deduction of any income, of any allowance or any expenses will be allowed to them. So are they supposed to file the income tax return? If they earn only the above incomes and their TDS is deducted, there is no need to file the income tax return. They are only earning these above 3 incomes and their TDS is deducted, then there is no need to file the income tax return. Sir, what is the TDS section over here? In this case, the TDS section is 194E, 20% tax plus surcharge if applicable, and says you should deduct the TDS on payment or credit, whichever is earlier, and the threshold is not there. Even if you pay a single rupee, you have to deduct TDS under this section. Sir, next one, whether umpire and referees are also covered in as a sports person? No. Umpires and referees are no doubt a professional, but they cannot be qualified as a sports person. Sports person means who actually play the sport and not the umpires and referees. Yes, if the umpires and referees are covered, and if you are making payment to them, if you are making payment to a resident umpire and referee, deduct TDS under 194J, and for non-resident, deduct TDS under 195. This section is subject to 20% flat tax without any benefit of basic exemption limit. All special rates are subject to special tax rates only. Directly 20% tax will be applied on you. The benefit of 2.5 lakh and 3 lakh benefit will not be given to you. I hope it is clear to all of you. Now, the next section, 115JG. Let me explain you the background of this. This is only for a foreign bank who has an Indian branch. Suppose there is a Bank of Germany who has an Indian branch. That is, an Indian branch is in Delhi or is in Mumbai or is in Chennai. Now, if you convert that branch into an Indian subsidiary, there are a lot of tax benefits that the government is going to give you. Listen carefully. The bank is foreign, the branch is Indian. The foreign bank has an Indian branch. A lot of foreign banks have Indian branch. HSBC has Indian branch, Citibank has Indian branch, Standard Chartered has Indian branch, Barclays has an Indian branch. So a foreign bank has an Indian branch, and if they want to convert that into foreign company, if they want to convert that into an Indian subsidiary, then we are going to give them a lot of benefits. What benefits? They have a lot of questions. First question, if an Indian branch will be converted into an Indian subsidiary, then whatever capital assets will be transferred, what will happen with that? That will be fully exempt, don't worry, as per section 115JG. Similarly, if an Indian branch is converted into an Indian subsidiary of a foreign bank, then whatever losses are there and whatever UAD are there, will you allow that to carry forward to the new company? Yes, it is allowed to carry forward to the new company. You can carry forward in the new company for another 8 years. Okay. Third one, if there is an Indian branch of a foreign bank, now that is converted into an Indian subsidiary, will you allow me to carry forward the MAD credit available with me? There might be some MAD credit available line with me. Will you allow me to carry forward that also? The answer is yes, you can carry forward that also with you. Don't worry about it. No capital gains, losses and UAD can be carried forward, and even MAD credit can be carried forward, but everything should be done as per the scheme notified by central government, and for that central government has given a big notification. You have to fulfill all these notifications, whatever is mentioned in this, you have to fulfill all these conditions. Now there are a lot of conditions that we need to fulfill. So first of all, and there are a lot of doubts which will come to our mind. All of them are resolved to this notification. First of all, what will happen with the current year depreciation? The year in which the conversion is happening, the current year depreciation will be apportioned between the predecessor and the successor. That is, it will be apportioned between the branch and the new company on the basis of number of days the assets are used by them. Second, what will happen with the set off and carry forward of losses? Yes, non-speculation losses will be allowed to you. Speculation losses are not allowed to carry forward in case of amalgamation. It's a kind of amalgamation only. So non-speculation losses and UAD you can carry forward to the Indian branch. You can give to the Indian company from Indian branch, and for UAD you can carry forward for infinite number of years, but for losses you can carry forward for fresh 8 years. I hope it is clear to all of you. What will happen with the WDV of the assets? In the branch there are so many depreciable assets. Now all those assets will come to the Indian company. Whether I will get depreciation? If yes, what is the WDV? Don't worry, whatever is the WDV of the Indian branch, that will become the WDV of the Indian company also. Don't worry about us. Don't worry about that. Next, what will be the cost of acquisition of other assets which are non-depreciable assets, like land, like jewelry, like investments? So whatever is the cost in the hands of the branch, that will become the cost in the hands of the company also. The period of holding will also be clubbed. Don't worry about it. The period of holding will be counted from the day on which the branch has purchased the assets and not on the day on which you have got the assets. Okay, don't worry about that also. Next one, what about the MAT credit? The MAT credit, whatever is lying with the branch, that will all be given to the company, and you can carry forward for another 15 years. Don't worry about it. What about VRS expenses? VRS expenses are apportioned over 5 years. If there is any balance period in 5 years, VRS expenses, voluntary retirement scheme expenses, are allowed as deduction in 5 years. If there is any balance left in that, whether that will be carried forward by the Indian subsidiary, yes, the Indian subsidiary can carry forward for the remaining period of years. Next, very important point, for banks there is a deduction given by the government of India for provision for bad and doubtful debts. Now, whether they will also be getting the deduction of actual bad debts, Yes, there is a condition. If your actual bad debts exceeds the provision for bad debt, then you will get the deduction of actual bad debts also. Now, when you compare the actual bad debts, you compare the actual bad debts with opening provision plus current year provision. So while counting the actual bad debts, while comparing the actual bad debts of the Indian subsidiary, the new company, you need to take the opening balances of the branch also, and then you should take the current year provision for bad debt. For that, you need to consider the opening balance of provision for bad debts of the branch, and then you need to consider the current year provision for bad debt, and then compare with the actual bad debt to find out whether it is exceeding the provision for bad debts or not. Last but not least, there is a foreign company for which there is subsidiary in India, and that foreign company will be getting shares. Now, obviously, now, because if in India subsidiary is made, who will be there has to be some parent company now. Who will be the parent company? The actual company, the actual branch of the actual HO of the company will become what? Will become the parent company. So they will be getting shares from Indian subsidiary. Whether they will be liable for 56(2)(10) because they are getting shares from Indian company. Shares are giftable asset. Whether they will be liable 56(2)(10), the answer is no. 56(2)(10) will not apply on them. Okay. And last but not least, if you fulfill all these conditions, your all capital gains exemption, your losses will be carried forward, MAD credit will also be carried forward. But if you violate any of the condition in future, then the AO has the power to what? Withdraw all the exemption, and he will pass an order within 4 years from the end of the financial year in which you violate the condition. For example, in 2029, if you violate the condition, then till 31st March 2023, if in 2029 you violate any of the condition, all the benefits will be withdrawn, and the AO will pass the order rectifying your order within 4 years from the end of the financial year in which you make the mistake. I hope it is clear to all of you. So let's move on with the next part, that is presumptive taxation for non-residents. So today we are going to talk about presumptive taxation of non-residents. Now remember, presumptive taxation we have done earlier also in the chapter of PGBP, but that was presumptive taxation mainly of residents under section 44 AD or 44 ADA. Today we are going to talk about presumptive taxation mainly of what? Only of non-resident, non-resident and non-resident. Now the very first section over here is section 44B, which talks about shipping business for non-resident. But this does not include cruise shipping now after Finance Act 2024, because Finance Act 2024 has made a separate section for cruise shipping. So cruise shipping will come later on. Right now we are not talking about cruise shipping. We are only talking about normal shipping business, where a non-resident is giving you shipping services for transportation of passengers, for transportation of goods, for transportation of livestock, and for transportation of mails. Okay. Now, in this case, there's a lot of problem in collection of tax. Suppose, for example, a non-resident ship owner lives in Singapore. Now he comes to Bombay or he comes to Chennai. Now when he comes to Chennai, he loads people from here, he loads carriage from here, he loads goods from here, he loads livestock from here, and say earn 1 crore rupees. Now how will the government of India take tax from him? For that purpose, because he will take all those things, he will go out of India, and when he will come back to India, nobody knows. So how will the government of India collect tax from him? So for that purpose, the government has brought one section by the number called as 172. Now 172 is a non-obstantive clause. It overrides the entire income tax law. Now 172 starts with a golden word, notwithstanding anything contained in any other provisions of the Income Tax Act. You have to follow what I am going to say. Now what is 172? 172 tells very clearly, when a non-resident ship is leaving India, then whatever income they have earned, whatever revenue they have earned, of that 7.5% will be deemed to be income. Suppose the ships which are leaving India, they are earning 1 crore rupees as the revenue. So out of that 7.5%, 7.5 lakh will be considered to be deemed income of the non-resident. Now in that 1 crore, if the assessee is also charging some handling charges or demurrage charges, those should also be included in 1 crore, and for that also you should take 7.5% as deemed income. So 7.5% will be of the amount received, which will also include handling and demurrage charge. You should take 7.5% of that particular revenue. That will be your deemed income. So from that, will I get any deduction? You will not get any deduction, because section 172 overrides what? The entire income tax law. Because it overrides the entire income tax law, you will not get any deduction from that 7.5% of any PGBP expense, of any set off of loss, of any chapter 16. Nothing will be allowed. Whatever amount is left after 7.5%, on that you will be directly liable to pay tax at the rate of foreign company tax rate. So foreign company tax rate will be applied on me. I am an individual. Still foreign company tax rate will be applied on you under section 172. 35% tax plus surcharge if applicable, and cess. 35% tax will be applied on me as per the foreign company. Yes, as per the foreign company, the tax will be applied on you, and the government will take tax from you. That's it. This completes section 172. So don't you feel there is a lot of injustice with me? Yes, I agree there is a lot of injustice with you. So you have an option in the next year. In the assessment year, you can come and follow what? Follow 44AB. Now 44AB only overrides section 28 to 43. It means it only overrides the PGBP provision. It does not override the entire income tax law. So in 44AB, again you will show the revenue as 1 crore and deemed income as 7.5%. 7.5 lakh will be deemed income. From that, PGBP expense will not be allowed because PGBP is overridden. No PGBP expense will be allowed. No unabsorbed depreciation will be allowed because unabsorbed depreciation is also covered in PGBP only section 32 subsection 2. Yes, but from that 7.5 lakh you can reduce if there are some losses which are taxable in India, which are assessable in India. You can reduce chapter 6A also, and then whatever amount will come on that you will apply your applicable tax rate. Now you will not apply 35% tax rate. If you are an individual, you can apply your applicable slab rate, and then whatever amount will come, that will be your tax payable. And whatever tax you have already paid under section 172 last year, that will be considered to be what? As your advance tax, and the department will give you the refund along with the interest. Don't worry about it. So section 172 is a recovery section which is applied in the previous year, and in the assessment year 44B is an optional section. If you want to come, come. If you don't want to come, don't come. The department will be happy with that. Even if you don't come, the department has already taken 35% tax from you without any deduction. But if you come, it is beneficial for you. File the return and claim your refund. Okay. Now, in 44B, there is one more income which is there, which is not covered in 172. That income should also be known to the student. So which is that income? In 44B, there is one more income which is not covered in 172. For example, if the ship leaves from Singapore and goes to Dubai, and leaves from Dubai and goes to Singapore, and the money is received in India. Where is the money received? The money is received in India. Then whether that is covered under 172? The answer is no, because 172 is only applicable if the ship leaves India. 170 is not applicable if the ship leaves from Singapore to Dubai or Dubai to Singapore. But that income is also taxable in India because the money is received in India. So that income will be directly classified where? That income will be directly classified under which section? Under section 44B itself. This income is only chargeable under what? This income is not covered in 172. It is chargeable only in 44B. So 172 covers 44B covers two income, which is one is common to 44B covers two income. One is common to 172 and one is not common to 172. Then I have put some distinction between the two. 172 is the recovery mechanism and 44B is the charging section for computation. 172 only covers one payment where goods are shipped at any port in India, but 44B covers two types of payment where the goods are shipped at any India and also shipped outside India, Singapore to Dubai, Dubai to Singapore, received in India. 172 you will apply 35% flat tax rate, and then in 44B you will apply the normal tax rate. 172 overrides the entire income tax law. 44B only overrides section 28 to 43. Therefore in 172 you will not get any deduction, but in 44B you will claim deduction of brought forward losses and chapter 6A. I hope it is clear to all of you. Now let's go on to the next presumptive section 44BBA. This is in respect of non-resident who are engaged in the business of operation of aircraft. For them the deemed income is very simple. If the aircraft is leaving from India, whatever money they will earn, 5% of that will be deemed to be income. And if the aircraft is leaving from anywhere outside India, but the money is received in India, where is the money? Aircraft is flying from anywhere outside Indian airport and the money is received in India, then also 5% will be deemed income. It is as simple as that. There is nothing great in this particular section. So if the aircraft leaves from India, then the money can be received in India or outside India. It is taxable in India. And if the aircraft leaves from outside India, then the money has to be received in India. Then only it is taxable. 5% will be deemed income. Now the third section 44BBB. This is a very, very special point which we need to keep it in mind. This third section is only applicable to foreign company. It is not applicable to all other assessees. The previous two sections were applicable to all kind of non-resident assessees, which may also include foreign company also if the foreign company is a non-resident. But the third section is only applicable to foreign company. What is that foreign company is doing? The foreign company is engaged in civil construction or erection of plant and machinery or testing or commissioning as a turnkey project. Turnkey project means a project which is complete in every sense. A project which is 100% complete, it is called as a turnkey project. Therefore, if a foreign company is giving you some services with respect to civil construction or erection of plant and machinery or testing or commissioning of a turnkey project, then they will be subject to 10% deemed income. 10% deemed income will be subject to tax. Now, in this section, there is a special benefit which was not there in the previous two sections. What is that special benefit? In this section, If you want, you can show the profit lower than 10% also, but for that you need to fulfill two conditions. You need to maintain books of accounts as per 44AA, and you need to conduct tax audit as per 44AB. So if you conduct tax audit as per 44AB and if you maintain books of accounts as per 44AA, then you can tell the department that my profit is not 10%, it is 8%, 7%, 6%. You have the right to show the lower profit also. Okay. Now the next section 44BB, this is also applicable only for all the non-resident. This is also applicable to all non-resident. Just 44BBB is only applicable to foreign company. Rest all the sections are applicable to all the non-resident. Now what is the assessee doing over here? The assessee is providing some services to you, providing some facilities to you, and giving plant and machinery on hire. The assessee is doing three things over here. The assessee is providing some services, providing some facilities, or giving plant and machinery or hire for what? For extraction, production, or prospection of mineral oil. Okay, I am engaged in mineral oil business. I am taking some services, some facility, or some plant and machinery on hire from the non-resident. So whatever income the non-resident will earn, that will be subject to 10% deemed income. Okay. Now, one doubt which will come over here is, before that, one more thing that I would like to say, which is similar to the previous section. In this section also, if you maintain books of account and if you conduct tax audit, then you have an option to show lower profit than 10% also. You can show 8%, 7%, 6%, 5%, and even you can show the losses also. If your income is not positive, it is into loss. You can show losses also under this particular section. Okay. I hope it is clear to all of you. Let's move on to the next part of the same section. Pay absolute attention now, all of you. The next part of this section is, what if the services which are given by the non-resident are of the nature of FTS? Whether then this section will apply, whether then this section will apply, if the services is in the nature of what? FTS. Whether this section will apply or the provisions of 115A and 44DA will apply. So the CBDT has given very clearly in the law itself that if the services are special services of FTS, if it is classified in the definition of FTS, then it will be covered under 44DA or 115A as the case may be. It means it will only come under, only those services will come in 44B which are not in the nature of FTS and which are not in the nature of FTS. If it is in the nature of FTS, go to 115A or 44DA. Now, there are some general knowledge questions that we need to keep it in mind. Under section 44AD, which we have done in PGBP, or 44ADA, which we have done in PGBP, or 44AE, which we have done in PGBP, that is presumptive income for business profession and that truck owners, can the AO say that, no, your profit is more than what you have declared? Yes, in those sections, the AO has the power to say that. If you are showing 8%, the AO has the power to say that your profit is more than 8%. Why? Because the law says 8% or such higher income as claimed to have been earned by the SSE. But in these sections, 44B, 44BB, BBB, BBA, in this section, whether the AO can increase your income, the answer is no, because in this section, such words are not used, which are used in 44AD, ADA and 44AE. I hope it is clear to all of you. Next one is a special benefit given to the foreign companies. If the assessee is only earning income under 44B or BB or BBA or BBA, and if the assessee is a foreign company, then the assessee will not be liable for MAT. If they only earn these incomes, they will not be liable for MAT under the income tax law. Plus. Next point is for this section and the previous section. That is for 44BB and 44BBB. If you are covered under 44BB and BBB, you will not get deduction of UAD and brought forward losses. Both of them will be denied to you. So in this section and in the previous section, the UAD and brought forward losses will not be allowed to you. I hope it is clear to all of you. Now coming to 44BBC. What is 44BBC? As I have told you, from 44B, they have removed cruise shipping, and for cruise shipping, they have made a separate section that if a non-resident is engaged in operation of cruise ships, then their deemed income will be how much? Their deemed income will be 20% of the amount received or paid to them. So whatever is the amount received by them, of that 20% will be considered to be PGBP income. Now there is one relaxation which is given to them over here. Now what is that relaxation? For that I will make one small diagram first and then I will explain you. Okay. Now to explain this, they have also made one separate section. First of all, they have said that 44BBC will be applicable to non-residents who are operating cruise shipping in India. They will be liable to 20% deemed income tax. Okay. Now they are also giving some exemption to these people. Suppose there is a foreign company over here and there is a specified company over here. First of all, we need to understand the definition of specified company. Who is a specified company? Specified company means it is not a domestic company. It is other than a domestic company who is running some cruise shipping in India and they are following 44BBC. So this is a foreign company, another foreign company who is following 44BBC. Okay, now listen carefully. Now suppose a foreign company gives a ship on cruise lease to this specified company. One foreign company is giving ship on lease to another specified company. And who is that specified company? It's not a domestic company. it is following 44 BBC in India. Okay, it is running cruise ship in India and following 44 BBC. Now, this company will pay lease rental. Specified company will pay lease rental to foreign company. So whatever lease rental are paid to the foreign company, those will be exempt. There is one more condition, provided they both should have a common parent. They both should have a common holding company. So listen carefully now. Once again, they have made it very complicated. There is a foreign company who is giving ship on lease to another specified company. Who is that another specified company? That is also a foreign company who is following 44 BBC. Now, whatever rental is earned from the specified company, that will be exempt, provided they both should have a common, what? Common parent. Check it please. This is what it is mentioned over here in section 1015 BC. I hope it is clear to all of you. You can take a photograph of this chart later on if you want. I have made you write all these things in the class also, if you remember. Now, coming to one last section over here in the series of 44, that is how much deduction will be allowed into the branch in India of a non-resident. A non-resident has a branch in India. Now, how much head office expenses will be allowed to you? Whatever head office expenses are allocated in India, will the government of India give you fully? The answer is no. The government is not going to fully allow you. They will allow you up to a particular percentage only. So, how much they will allow? They will allow you to the extent of 5% of adjusted total income or the expense which are attributable to India, whichever is lower. So, 5% of adjusted total income or the expenses which are what? Debited in the P&L in the form of head office expense, whichever is lower, that will be allowed. Now you will be asking, what do I mean by adjusted total income? Adjusted total income is nothing but your total income only. But after adding back few things, you will add back few things to a total income. First you compute total income, then you add back few things. Which all things? First of all, add back UAD, then add back brought forward losses which you have set off, then add back capital expenditure of family planning. Don't add back revenue expenditure of family planning. Only add back capital expenditure of family planning. Then add back chapter 6A and then add back the actual head office expenses debited to P&L. After doing all those things, take adjusted total income will come, take 5% of that. Now, after doing all these things, if the adjusted total income is coming to negative, then what shall I do? Now, let me tell you what shall I do in that case. In that case, you are supposed to take average adjusted total income of last 3 years. Do this exercise for the last 3 years. Take an average, divide by 3. If last 3 year data is not there, do this exercise for last 2 years. If last 2 years data is not there, do this exercise only for last year, and then you will get the what? Adjusted total income. Take 5% of that, and then you compare with your actual head office expenses, whichever is lower, that will be allowed to you as a deduction. I hope it is clear to all of you. Now let's go ahead with the next part, the discussion which we have left at the beginning of the chapter, that which incomes are taxable in India for non-resident. Only income which are accrued in India, or which are received in India, or which are deemed to received in India. These three terms we have understood at the beginning, and the fourth term is income which are deemed to accrue or arise in India. So now we are going to learn what do I mean by the term income which are deemed to accrue or arise in India. Deemed to accrue in India means what? So, and now we are going to talk headwise. First we will talk about PGBP, then say salary, then IFOS, HP, and for capital gains we are going to learn in the chapter of Vodafone case law. Okay, so pay absolute attention now. When business income is taxable in India, for business income of a non-resident to be taxed in India, the non-resident should have a business connection in India. So what do I mean by business connection? Business connection means the non-resident should engage in any business activity in India through a person acting on behalf of the non-resident. So if a non-resident has any person in India who is working on behalf of the non-resident, that activity will be called as a business connection in India. It means if a non-resident has a branch in India, has an office in India, has a factory in India, you can say the non-resident is working in India, is doing a business activity in India on behalf of a non-resident. There is some person who are doing some activity in India, then there is a business connection, and therefore the income will be taxable. Now, the scope of the definition of business connection has been expanded over the years. Now the government is saying that not only a branch or a factory or an office or a quarry or a mine or an extraction place will be considered to be a business connection, but also something more can be called as a business connection. Listen carefully, it's a complicated concept. Generally, a non-resident will be liable to tax in India in respect of its business and profession income only if it has business connection in India. Business connection means there should be some person on behalf of non-resident who is working over here. There should be some factory of that non-resident. There should be some place of that non-resident. There should be some fixed place of that non-resident. There should be some branch of that non-resident. There should be some office of that non-resident. This was a traditional concept that is applicable even today. But now the scope of business connection has been expanded by the government of India in the last few years, and the government has said that even if there is a agent who is sitting in India who has been given an authority to habitually exercise to conclude contracts in India, The non-resident is in United Kingdom. There is an agent in India who has been given an authority to habitually exercise. Habitually means regularly exercise, regularly enter into a contract on behalf of the non-resident in India. Then that is also a business connection, and even that will also be liable to tax in India. Similarly, point number B says that even if you don't give such authority to that non-resident, which authority? Even if you don't, even if you don't give such authority to that agent, even if you don't give such authority, which authority? Even if you don't give such authority means the authority to conclude contracts to the agent, but you only give the power for him to regularly deliver goods on behalf of you, then that is also covered under the income tax law. I hope it is clear to all of you. So earlier what used to happen? Only a physical location of a non-resident in India was subject to tax. A non-resident need to have a branch in India, office in India, factory in. Now, even a single person who has an authority in India to conclude contract on your behalf, that will also amount to business connection. Even a single person who is delivering goods on behalf of you, that is also a business connection. And third point, and if a non-resident is putting one person in India who secures orders in India for you, a non-resident is outside India, there is Mr. A, an agent in India who is securing order for you, but mainly and wholly for you. He should not be doing that for everybody. He should be doing mainly and wholly for you. Then that person will also be considered to be a business connection in India and will be liable to tax. Now, in the third point, there are some scenarios that you need to understand. Suppose there is a non-resident outside India. That name of that non-resident is Mr. A, and I am an agent in India. I am Mr. X. You need to understand with the help of this example. The non-resident is outside India. The name of that person is Mr. A and I am Mr. X. Now that Mr. A has told me to exclusively take orders for him. So I am in India taking exclusive order for him. Now I am also taking some order for his brother. Mr. A has a brother in London, Mr. B. I am also taking some order for his brother. Or try to understand. I am also taking some order for his related party. Then in that case, whether that will also be covered in C? The answer is no. Because for his brother, I am taking only some order. I am not taking mainly and wholly. But the law has made an amendment here that if you are taking some order for his brother, and the brother controls the Mr. A, or Mr. A controls Mr. B, or if both of them are controlled by some third person, then in case of that, your brother's income will also be deemed to accrue or rise in India. This is what it is written over here. Very dangerous point. Now, one last thing that I would like to say, this is all called as agency business connection. All this business connection, first point number A, agency business connection, B, agency, C, agency. Now all these 3 points are only relevant and only business connection will amount only if these 3 incomes, only these 3 agents are dependent agents. If they are dependent on the non-resident, they will exactly do what non-resident will say. They are exclusively for non-resident. Only then it is deemed to accrue or rise in India. If they are independent agents, then the income of the non-resident will not be deemed to accrue or rise in India. That is what it is written over here. Now, the government has gone one step ahead from 1/4/2022 that if the non-resident has a significant economic presence in India, forget about branch, forget about office, forget about factory, forget about agency PE, forget about all those things. No need of all those things. If a non-resident has a significant economic presence in India, then that also will be liable to tax. Then whether or not the non-resident has provided services in India, whether or not the non-resident has a place of residence or place of business in India, whether or not the non-resident has entered into an agreement in India, it doesn't matter. Significant economic presence can also amount to business connection. So what is significant economic presence? Significant economic presence has been defined by the law. If a non-resident is entering into a transaction with any person in India, for download of data, software in India, and if the aggregate payment exceeds how much? 2 crore rupees. So if a non-resident is entering into a transaction with an Indian person, and if the aggregate payment made by the Indian person to that non-resident is more than 2 crore rupees, then in that case, that non-resident will be called as that they have a significant economic presence in India and they will be liable to tax. Similarly, if a non-resident is doing systematic and continuous soliciting of business, means if a non-resident is engaged in some kind of advertisement in India, like Facebook, like Google, like Instagram, etc., and if they have at least 3 lakh users in India, then that also is deemed to accrue or arise in India. I hope it is clear to all of you. So if a non-resident is doing what? Advertising income in India, and they have at least how many users? 3 lakh users in India, then that is also deemed to accrue or rise in India. I hope it is clear to all of you. Now this is what the definition of business connection was. Business connection includes agency PE. Business connection also includes significant economic presence. Now what does business connection does not include? That also we need to say. In those cases, you will not be liable to tax in India. First, If all operations of the non-residents are not carried out in India, then the business connection will be partially taxable. The business income will be partially taxable and not fully taxable. If the non-resident is not exclusively engaged in all the operations in India, then proportionate income will be taxable, full income will not be taxable. How much proportion? That is determined by DTAA. That is not mentioned under the income tax law. But there are three incomes which will always be taxable in India. These three incomes are one by one I am saying here. First income, let me give you an example. There is Samsung, there is Facebook. Now Samsung tells Facebook that I want to advertise my product. I want to do advertisement. Now for that purpose, the Facebook is asking Samsung, which is your target audience? Suppose the Facebook says that my target audience is India, and for that purpose I want Indian target audience, and for that Facebook is making some payment to Samsung. Samsung is making some payment to Facebook for doing advertisement in India and targeting Indian customer. So whatever income from advertisement is earned by Facebook for targeting Indian customer, that is always deemed to accrue or rise in India. Similarly, second one, suppose there is a non-resident who is purchasing some data from a person resident in India and selling to Samsung. A non-resident is purchasing some data from a resident in India and selling to Samsung, and whatever income is earned from sale of that data will also be income taxable in India. Now, with the help of that data, what will Samsung do? Samsung will target Indian customers. In point number 2, Samsung has collected data from a non-resident, and with the help of that data, what the Samsung will do? Samsung will send messages to different people in India, and with the help of that, Indian people will purchase the product of Samsung, and whatever income Samsung will generate from the sale of such goods and services, that will also be liable to tax in India. Check it please. I hope it is clear to all of you. Next one, we are learning the exclusion of business connection. So the second exclusion of business connection is if you purchase in India and then export it immediately, you are not liable to tax in India. If a non-resident comes to India, purchase goods in India and then export it, not liable to tax in India. Similarly, if a non-resident news agency comes to India, news agency, who are news agencies, okay, comes to India and collect news for transmission out of India. They are coming to India for collection of news, but the transmission will not happen in India. The transmission will be done out of India. Then also that is also not taxable in India. Similarly, if a non-resident shooting cinematographic film producer is coming to India for filming a movie, if a non-resident film producer is coming to India for filming a movie, then that is also not taxable, provided if the non-resident producer is individual, then he should not be citizen of India. If he is a firm, then none of his partners should be citizen of India and none of his partners should be resident of India. All should be foreign citizen, all should be non-resident. Similarly, if he is a company, then all the shareholders should be foreign citizen and all the shareholders should be foreign resident. None of them should be Indian resident. And last but not least, what does not amount to business connection? If a foreign company who is engaged in mining of diamonds is coming to a special notified zone which is in Mumbai, BDB, Bharat Diamond Bourse, which I have told you in class. Bharat Diamond Bourse, it's a diamond market which is there in Bombay, BKC, Bandra Kurla complex. Therefore, if a foreign company is coming to India for exhibition of its uncut, for display of its uncut and unassorted diamonds, then that is not subject to tax. If they restrict their activity to display, then it is not subject to tax. If they go beyond display, then it will amount to business connection. This completes the business connection. Now let's talk about house property and IFRS income. When the income from property, asset or source will be taxable in India, when it will be deemed to accrue as in India, when the property is located in India, when the movable, immovable, tangible property is located in India, then it is deemed to accrue as in India. When the immovable property is located in India, land is located in India, building is located in India, debentures is of Indian company, bonds is of Indian company, lottery is of Indian government, Indian state government, then it is accrued in India and it is deemed to accrue as in India. You have to pay tax on that. When salary income is accrued in India, when the salary is earned in India, when can I say the salary is earned in India? When the services by the assessee is rendered in India. Whenever the services are rendered in India, it is deemed to be accrued in India. What about if the salary is paid by the employer for rest period or leave period? If rest period and leave period are also part of agreement of the employee, then for rest period and leave period, whatever salary is paid, that will also be accrued in India. That will also be taxable in India. Next one, section 913. What about the salary paid by the government of India to the officials outside India? Suppose government of India is paying salary to its employees in US, in Indian embassy, in USA, in Indian embassy is there in USA. The government of India is paying some salary to them. Whether that salary is also accrued in India? Yes, that is also accrued in India if it is paid to citizens of India. But that is subject to tax, definitely. But the allowances and the perquisites which are given by the government, to its citizens outside India, that will not be subject to tax as per section 10(7). I hope it is clear to all of you. Next one, section 9(1)(4). If a dividend is paid by an Indian company, then it is always deemed to accrue or arise in India. Dividend paid by Indian company is always deemed to accrue or arise in India. Okay. Now let's go ahead with the next section, that is section 9A. It is an hopeless section, not very important for examination, let me tell you very clearly, but still it is my duty to teach you all everything and revise everything with you all. Pay attention please. Suppose there is an international fund investment, there is an eligible investment fund in UK, but the fund manager is in India. Now just because the fund manager is in India, the income of the fund cannot be made taxable in India. That's what the government of India is saying. Therefore, if the fund is outside India and the manager is in India, then the income of the fund will not be liable to tax in India, subject to 17 conditions. How many conditions? 17. Out of which the fund has to fulfill 13 conditions. Fund has to fulfill 13 conditions and the manager has to fulfill 4 conditions. The 13 plus 4, 17 conditions have to be fulfilled. So let us try to understand first of all, what are the 13 conditions that the fund has to fulfill. First of all, the fund should be non-resident in India. Okay. Second, the fund should be located in a country with which India has DTAA. Okay. In the fund, directly or indirectly, the Indian resident should not be more than 5% of the total fund. Suppose the fund is of 100 crore, then the investment of the Indian resident should not be more than 5 crores. Okay. But, the eligible fund manager for the first 3 years can invest up to 25 crores. Suppose if the fund is of 100 crore, then the eligible fund manager can invest up to 25 crore, even though it amounts to more than 5%, it is allowed. It is allowed to the fund manager, but only for the first 3 years and only up to 25 crores, not more than that. Condition number D. The fund should be located in a country in which there is an investor protection regulation like SEBI. There should be someone to protect them like SEBI. Okay. Next, E, F, G. These 3 conditions are not applicable to some people. To whom it is not applicable, that we will see later. But try to understand. There should be at least 25 members in the fund who are not connected to each other. There should be at least 25 unconnected members. Suppose in the fund, total 100 members are there. Members means investors. Total 100 investors are there. Therefore, 75 can be connected to each other. At least 25 should be unconnected to each other. They should not be related to each other. Any member along with the connected person should not hold more than 10%. So if any member along with its connected person should not hold more than 10%. 10 or less members should not hold more than 50%. It should be less than 50%. So 10 members along with its connected members should not hold 50% or more. It should be less than 50%. Now, the fund should not invest in any entity more than 20%. So the fund should diversify the funds. Don't invest 30-40% in one single company. Okay. Fund should not invest, no investment shall be made by the fund in its associated entity. Fund should not invest in associate entity also. Now, next point number J has 3 points. The monthly corpus average of the fund should be 100 crore. Every month average corpus of the fund should be 100 crore. If the fund is newly incorporated, then they should reach 100 crore within 12 months. So if the fund is incorporated in December 24, then it should reach 100 crore by the end of next November. That is within 12 months, they should reach 100 crore. If the fund is closing this year, it is winding up this year, then this condition is not applicable. So these are the 3 points which are mentioned over here. The fund shall not carry on or control any business in India. They should not be engaged in any business in India. They should not control any business, manage any business in India. The fund should not engage in any activity which amounts to business connection. They should not do anything which is similar to a business connection. And last but not least, the fund manager will get some remuneration from the fund. The remuneration paid to the fund manager should be paid as per the prescribed manner. It should not be less than the manner prescribed by the government of India. For that, the government has made separate rules which are not applicable for your exam, fortunately. Now, the condition number E, F, G are not applicable if the fund belongs to the government of foreign country or if it belongs to central bank of a foreign country. So, if the fund is the government of foreign country which is investing, and if the fund is a government of a central bank of a foreign country, then these three conditions are not applicable. Which conditions? E, F and G is not applicable, which I have already told you. These 3 conditions are not applicable to certain people. Now, what all conditions eligible fund manager has to fulfill? Fund manager also has to fulfill certain conditions. First, the manager should not be employee of the fund or the connected person of the fund. The manager should not be employee of the fund or the connected person of the fund. Second, the fund manager should be a registered fund manager. Third, the fund manager should act in the ordinary course of business. This is his day-to-day business to manage fund of the people. And the fund manager should not be given more than 20% profits. More than 20% profit should not be given to him. Now, if you fulfill these 17 conditions, then the income of the eligible investment fund will not be liable to tax in India. It is not deemed to accrue or rise in India as per section 9A. Now, who will check whether all these conditions are fulfilled or not? For that purpose, the investment fund has to fill a prescribed form within 90 days from the end of the financial year. If they have to fill a prescribed form within 90 days from the end of the financial year, a statement has to be given that they have fulfilled all the conditions, and if they fail to fulfill, then you can write down over here they will be liable for a penalty under 271 FAB of how much? Of 5 lakh rupees. How much penalty? It is given in the chapter penalty, but here also you can write down. It is 271 FAB, 5 lakh rupees penalty will be imposed on you. Okay, I hope it is clear to all of you. Now, there are some relaxation and some modifications given if the fund manager is located in IFSC. Where? If the fund manager is located in IFSC, then first of all, E, F and G conditions are not applicable the way it was not applicable to the government of foreign country. Remember, E, F, G is not applicable. And K is applicable with some modification. If the manager is located in IFSC, K is applicable with some modification. So for that purpose, we need to say what is K. The fund should not carry on or control and manage any business in India. Okay, so this is the condition which is given in K. If the fund manager is located in IFSC, then this condition is slightly modified. How it is modified? It is similar to 1023 FE. The fund shall not carry on participate into day-to-day operations, but for the purpose of monitoring, it has the right, monitoring its investment, it has the right to appoint directors or executive directors, and that will not amount to participation in day-to-day business. This is similar to what it was there in 1023 FE. In the definition of fund manager also, there was one condition that the fund manager should be registered as fund manager. So this condition they have slightly modified if the fund manager is located where? In IFSC. So the person should be registered as a portfolio manager or investment advisor as per IFSC Act. So the fund manager which is located in IFSC should be as per the IFSC Act only. A normal fund manager will not work over here. Okay, I hope it is clear to all of you. And hopeless section not very important for exam. Don't pay much attention on this. Okay, section 9 was important. 9A is not important. Now let's move on to the next section, that is section 195, which is our very important section for what? Very important section for non-resident TDS. See, there are a lot of sections for non-resident for TDS like 194LB, 194LC, 194LD, 194E, but this is a master section. If you do not come under those sections, then come over here. If there is a specific section for TDS, then go under that. If there is no specific section for TDS, then you should come under section 195. Now, let us decode one by one the different points mentioned over here. Who will deduct TDS over here? Any person. Any person means what? The deductor can be any person. The deductor can be resident. The deductor can be non-resident. The deductor may have a business connection in India. The deductor may not have a business connection in India. The deductor may have any other presence in India. Deductor may not have any other presence in India. You can check it over here. The deductor can be any person. Who will be the deductee? The deductee has to be non-resident or foreign company. The deductee has to be non-resident or foreign company. The deductor can be any person. The deductee has to be non-resident and foreign company. Please keep this thing in mind. Plus, in this section, you don't deduct TDS on what? 194 LB, LC, LD. That is separately covered. You don't deduct TDS on salary also, because for salary, the TDS is covered already under section 192 for non-residents. Okay. So who is deductor? Deductor is any person. Resident, non-resident. Whether you have business connection in India, whether you have place of business in India, whether you have any other presence in India, or you don't have all these things, then also you are liable to deduct TDS. Who is deductee? Deductee is non-resident and foreign company. On what items you will deduct TDS? On every payment made to non-resident except 194 LB, LC, LD and salary. Plus one more important thing, the income should be, the payment which you are making to the non-resident should be chargeable to tax in India. If that amount is not chargeable to tax in India in the hands of non-resident, you are not going to deduct the TDS. The point is very clear over here. The amount which you are paying to the non-resident, that has to be taxable in India. Only then 195 is applicable, otherwise 195 is not applicable. Last but not least, what is the rate at which you are going to deduct the TDS? The rate is not mentioned in 195. It says that rates in force. For that, you need to see the Finance Act or DTAA. Finance Act and DTAA talks about rates in force. Income tax law does not talk about it. Okay. I hope it is clear to all of you. Along with that, you also have to fill certain forms, prescribed form like 15CA, 15CB for making payment out of India. Okay. Now, let's talk about the second part of this section. Timing of deduction. When will you deduct the TDS? Generally, you will deduct the TDS on credit or payment, whichever is earlier. But in some cases, you will deduct the TDS at the time of payment. What are those some cases? If the payment is of interest, payment is of what? Interest, and it is made by government or public sector bank or public financial institution. If the payment is of interest and it is paid by government or public sector bank or public financial institution, then you will deduct TDS on payment, not on credit basis. This is a very important part for examination, so please keep this thing in your mind. Okay. Now, next one, 195.6. 195.6 says what? when you are making a payment to a non-resident, you always have to fill the prescribed form, whether or not the payment is chargeable to tax or not. If it is chargeable to tax, then also you have to fill the prescribed form 15CA, 15CB, and if it is not chargeable to tax, then also you have to fill the form prescribed form 15CA, 15CB. Without filing a prescribed form, you cannot make the payment out of India. Every payment made outside India has to be along with the prescribed form 15CA, 15CB. Without that, it is not possible. Next one, 195 subsection 2. 195 subsection 2 is applicable. Suppose if I am making a payment to a non-resident and if I am not confident about whether the entire income is chargeable to tax or not. So in that case, the government is giving me an option to the payer that I can make an application to the AO, and the AO will determine the appropriate portion, and according to that, I will deduct the TDS. Suppose I am making a payment of 10 lakh rupees, but I am not sure entire 10 lakh is taxable or not. So tell the AO. AO will determine the portion. Now AO is saying that out of 10 lakh, 6 lakh is taxable. Therefore, you deduct TDS on 6 lakhs only, not on 10 lakh. Now, if you don't deduct the TDS on 6 lakhs, only 6 lakhs will be disallowed under PGBP under section 40A1, which we have done earlier in the chapter of PGBP. I'm just trying to interlink that. Now, some small case laws that Maruti Suzuki India Limited, the assessee was making some payment to non-resident agent whose income was not chargeable to tax. So the AO did what? The AO disallowed the expense. How can you disallow an expense which is not chargeable to tax? Suppose if you are making a payment to non-resident agent that is not taxable only in India. If it is not taxable only in India, the question of TDS does not arise only. And the question of TDS does not arise, why will I make an application under 195(2) and why will you disallow that expense? The disallowance is only possible if I am liable to deduct tax, and TDS deduction is liable under 195 only if the income is chargeable in the hands of non-resident. So both these case laws talk about the similar point. Similarly, in this Viscraft International Entertainment Private Limited also, the non-resident was not providing services in India. He was providing services outside India. Therefore, the income of the non-resident was not liable to tax in India. And therefore, because the income was not liable to tax in India, the assessee in India, the payer in India was not liable to deduct the TDS. Now, next section 239A is a very recently inserted section. Just 1 or 2 years back, they have inserted this section to address a very important issue. Let me explain you this issue first of all. Suppose I am a payer, you are a payee, I am making a payment of 10 lakh rupees to you and the TDS rate is 10%. So generally what happens? Generally, when I will make the payment of 10 lakh rupees to you, I will deduct 10%, that is 1 lakh, and I will pay 9 lakh to you, and then 10 lakh you will show as your income. Okay. But sometimes what happens? The payee says that I am not going to bear the tax. The payer will bear the tax. If you only bear the tax, the payee is putting the responsibility of tax on me, and the payee is saying that I want full 10 lakh rupees. So in that case, I have to bear the tax now. The payer has to bear the tax. Therefore, in that case, what will I do? I will pay 10 lakh rupees to you. I am a payer, you are a payee. I am in India, you are non-resident foreign company. I will pay 10 lakhs to you, and then I will do gross up from 10 lakhs. I will say 10 lakh is 90%. Therefore, 110% is how much? 10% is how much? I will do backward calculation and I will pay to the government. So that's what I did. Now, I did backward calculation. I borne the tax. Who borne the tax? Payer borne the tax. This is an important point in this section. Now, after 10-15 days, I came to know that I have whatever tax I have borne and have paid to the government of India. In that case, your income is not chargeable to tax only in India. So in that case, can I say I have wrongly paid the tax to the government of India because I was not liable to pay tax only? On that also I have grossed up and I have paid the tax. So in that case, the government says that if the tax has been borne by the payer, listen carefully, if the TDS on any income is borne by the payer and paid such tax to the credit of the central government and no tax was required to be deducted on such income. So I was not supposed to deduct any tax, but still by mistake I have paid the tax from my pocket only. Then within 30 days you have to make an application to the assessing officer for refund of such tax in form 29D. You are supposed to make an application to assessing officer within 30 days for refund of tax. Then the assessing officer may allow or reject. If he rejects, then he will give you an opportunity of being heard, and then the AO will pass an order within 6 months from the end of the month in which the application is received, and he will grant you the refund if it is allowed. If it is not allowed, then you can go for CIT appeal and appeal. You can appeal against the order of the assessing officer. So I hope it is clear to all of you. Now, one last thing in this chapter, which is the most important part of this chapter. A question can come on this in the examination, and if the question comes on this, you will be handicapped if you don't know this provision. You will not be able to start with the question only if you don't know this provision. Rule 115. There is a lot of confusion between students regarding Rule 115 and Rule 128. Let me clarify here itself. Rule 128 we will do later on in the chapter of DTAA. Rule 115 we are doing it today. So what is Rule 115? Rule 115 talks about when you are earning an income in foreign country, house property income, HP income, CG income, IFSC income, PGBP income, and you are earning in foreign currency, dollars, pounds. If you want to convert that income into rupees, you are supposed to follow rule 115. And what is rule 128? When you pay tax in the foreign country, when you pay tax in the foreign country in foreign currency, and if you want to convert that tax into INR, you will follow 128. So 115 is to convert income and 128 is to convert what? Tax. So how we will convert? We will convert the income today, and tax we will talk about later when we will discuss the provisions of DTAA. So you will convert your income into Indian rupees as per the TTBR on specified date. So what is specified date? So the rate is very clear. It has to be TTBR. You will convert as per TTBR only. The rate is very clear. You have to convert as per TTBR. But on which date? That depends upon the nature of income. If you are earning income from house property or PGBP except one PGBP, or if you are earning IFOS except two IFOS, 1 and 2. So if you are earning house property income or PGBP except one PGBP or IFOS except two IFOS, whatever are except over here, I will highlight that this is except, this is except. Then you will convert as per the last day of the previous year. 31st March 2025, whatever is the TTBR, you will convert as per that. What about others? For all other incomes, you will follow the TTBR on the last day of the preceding one. For example, salary was not covered in point number 2. For salary, you will take last day of the previous month. For the salary of month of April, you will take 31st March. For the salary for the month of May, you will take 30th April. For the salary for the month of December, you will take 30th November. For the salary for the month of Feb, you will take 31st Jan. Similarly, for interest on security, which is not covered in point number 2. In point number 2, interest on security is not covered. In point number 3, interest on security is covered. For interest on security, you will take last day of the preceding month. For PGBP, in case of non-resident engaged in operation of ships, like 44B PGBP, for that you will take last day of the preceding month. For all other PGBP, you will take last day of the financial year. For dividend, you will take last day of the previous month. For capital gains, you will take last day of the previous month, last day of the previous month, last day of the previous month. So just remember point number 2, rest all you can say is a balancing figure. Income from house property, last day of the financial year. PGBP except non-resident shipping business, last day of the previous year. IFOs except interest on security and dividend, last day of the previous year. I hope it is clear to all of you. Similarly, last point but not least, suppose if I am making you payment, I am in India, you are outside India, I am making you payment of $1 lakh. So I am deducting 10% out of it. So $10,000 I have deducted. Now when I pay that $10,000 to the government of India, I also have to convert that into rupees now. I cannot give dollar to CBDT now. I have to convert that into rupees. So I will convert that as per which rate? Again, you will take TTBR only. You will take TTBR only, but of which date? On the date on which the tax is required to be deducted. That depends upon whether the tax is required to be deducted on credit or payment, whichever is earlier, or whether the tax is required to be deducted on payment. On whichever date you are liable to deduct the tax, on that date, whatever is the rate, as per that rate, you are going to convert that $10,000 TDS and pay it to the CBDT in INR. I hope it is clear to all of you. So this is where I complete my promise of uploading the non-resident taxation. I asked you all on the Telegram channel. You all can join my Telegram channel also, CA Aarish Khan. I'll put the link in the description box below. You can check it over there. This is where I have completed the promise. I asked you all which is the next revision video that I shall put. You all told me that please put non-resident taxation and transfer pricing first because those are tricky topics. So I'm trying to put that for you all in full English. Okay. So take care all of you till then. I will try to come up with the next video very soon for transfer pricing and capital gains. I'll put in the next month. It's a big topic. I am not in India for the next 15 days. So I'll be putting capital gains in the next month, first week of the next month. Don't worry. Okay. And as far as transfer pricing is considered and taxation of trust is considered, that I will put it here itself in the next 1 week. So till then, take care all of you. I request you all to share these videos with all your friends in South India who wants to revise direct tax comprehensively in full English. If you want these notes, you can order these notes from our websites also, aarishkhan.com. Okay, you can see the link over there. You can see the website over here, aarishkhan.com. For any further details, you can call on this number also, which is mentioned over here. Okay, till then, take care all of you. And please give your opinion, give your review about how are you liking this revision video in the comment box below. Okay, till then, take care all of you. Bye.